first item is the consent agenda. Now, the minutes, they're listed on here, March 28 and April 23. Is it the April minutes you've amended since then, Jim?
Yes,
Yeah.
sir.
The minutes of April 23 that were posted, Nancy has distributed to everyone a revised version of that. Only revision is on pages 3, 4,
That's it.
and 3 and 4 in purple. You'll see that she has added a reference to the exhibits that support that topic of discussion, namely exhibits A, B, and C. And staff is seeking approval of the minutes as amended by the purple additions on pages 3 and 4. Is there any objection to the consent agenda items, namely today's agenda and the approval of the prior minutes?
Not that, but if we can, I'd like to amend them to move the adoption of proposed amendment, governance policy 2. If we could, to be before the committee assignments, just because that governance policy deals with the powers of the chairman and the appointments on the committees, and I have a proposed amendment I'd like to propose on that governance policy. So if we take it up later, right, it can wind up influencing that. So if we can take item 4 and combine it with item 2C.
Item 4.
Yeah.
After B.
Huh? After B, yeah, under 2B.
Okay. Anybody have any objection to that? Hearing none. We'll, at that point, we can't really, well, we can change the order of this.
Right.
Yeah, we'll just insert it there. Okay? With that amendment being made, do I have any objection to the adoption of the proposed agenda?
So you're doing the minutes and the agenda at the same time, not just the agenda? I just want to.
Yeah, unless somebody has objection.
On the amendment, the minutes for April 23rd, I'd like the record to show that there was an active conference call at the meeting, and the commission, at least I was not informed that the National Press Corps was on the phone that was set up by staff. I'd like that to be reflected in the minutes.
Does anybody have any objection to that being in the minutes? Hearing no objection, that'll be on there.
And it's a note to.
These are open meetings, so if national press or local press, anybody who wants to listen in on the meetings, is always available to listen in by conference call or by showing up.
Right, but don't we keep a log of people who show up here?
Actually,
Would there be a
this-
log on the
Is it
attendees?
pensions and investments, is that?
Yes.
That's one that we know, I don't know. Yeah, it's conveniently on the minutes, but we were not told that at the time. And I think it's important, when I walk into a room, I look and see who's in the room. And so, I wouldn't want somebody to place a bug under the.
I haven't heard any objection, anybody having that put in the minutes. So we'll put that in.
So are we going to amend the April 23rd minutes and then also include the same thing in the minutes today?
Is there a conference call going on now?
No, maybe I'm just confusing the issue.
Is there a conference call going on?
I want to make it clear, there are no conference calls, then or now or ever.
Is there a call now where people are listening in? No.
But any press member who calls in and wants to be allowed to listen in by telephone is allowed to listen in by telephone.
You've included them as people in the minutes who attended the meeting. Everybody here can be seen. And I'm not going to argue what is obviously a silly point. You can bug the place if you want to, but it is common decency to let people know who's here. And if there's a phone call going on with members of the National Press Corps, we should know it. That's all I've asked, if that's not appropriate.
And without objection,
Well, wonderful.
it's
Thank
been
you very
added
much.
to the list of attendees at the minutes of that meeting. Let's move on.
So just so I'm clear, the April 23rd minutes, because they do list the person who was attending via telephone.
Yes, put
The
that person's
April
name.
23rd minutes are approved as distributed. And then the minutes from today will reflect the issues that you raised regarding.
Since y'all have
this.
kindly listed her, because you know about it, I didn't know about it, I like that you have noted, everyone was informed that there was a phone call in place, and that the people were listening.
Yeah, but
That
Nancy's
will
saying
be
that will be in
noted in
today's
today's-
minutes versus the prior minutes.
Yeah,
Right.
Okay. I'm gonna ask for some staff help on this. I believe staff has distributed the pertinent portions of the compensation policy. But we are required, as I understand it, at or near the beginning of each fiscal year to adopt the standards by which the,
You voted on that.
I'd heard no objection, so it's a consent agenda, so it's adopted by unanimous consent. Would you like to, let it be a vote? Okay. So at or near the beginning of the fiscal year, we're supposed to establish the standards by which investment staffs pick their performance incentive compensation will be determined. And what staff has attached and what Herschel has recommended, and I'll let him speak to this, is that we carry forward the same standards and same percentages from last year. Is my understanding.
I do have one question related to this, and this is more for Hewitt, right? I mean, obviously, we changed asset allocation, we changed classifications. How does that change the policy benchmark? Because that's a component of the measurement, right, and calculation.
Maybe I'll take the first part of that. The recommended allocation changes and changes to the benchmark that were approved at the prior commission meeting will become effective. The asset allocation and benchmarks that were approved at the prior commission meeting would become effective July 1st, 2013. So the existing asset allocation and benchmarks would be in place for the rest of this fiscal year. So they would continue to have the historical as well as the go forward.
Yeah, we believe that's good practice unless there's been some really structural badness, if you will, to your investment benchmarks. We think it's best practice to change them at a specific point in time and move forward. But as a part of our review, we did review each of your benchmarks by asset class, recommended some minor changes really, and that was part of the investment policy recommendations.
So this is the benchmark that Bank of New York said was in the 95th percentile on average.
Your historic benchmark,
Yeah.
yes.
So if I understand this correct, our goal is to pay at the 90% top, 10 from the top. We're using two different scales here, but we're saying the top 10%, that's our goal. But our benchmark is the bottom 10%. And there's a tremendous mismatch here, and I don't know how to explain that to people. And I would like to have some advice on how to do that. Furthermore, maybe I should have done it, could have done it, think about it. I do believe we should have Bank of New York with you guys to actually see where we are benchmarked. Because we should know that. I mean, we could go from 95th to 100.
Sure. I'd be happy to comment on that now. Just want to make sure it's in the right order in the agenda. Okay, so there's a couple of issues there. I don't think anyone's goal is to be in the bottom 10 percentile of the universe. But it's important to note what that universe is and how important it is or is not as a goal of the overall fund. So universes, and the one constructed by Bank of New York, or really by any group that's trying to construct a public fund universe, is going to contain a wide array of public funds with different goals, different objectives, different decision-making groups. And it's looking at any point in time, 1 year, 3 years, 5 years, whatever period we're looking at, how do those returns array from top to bottom, without regard to risk, without regard to objectives. And the number one factor in determining where you are in a universe ranking is going to be your asset allocation, policy asset allocation. So as we discussed at the last meeting, you do have more alternatives in the average plan and less in stock, overall public equities. In the last 3 years in particular, public equities have outperformed most every asset class out there. It's a great thing. It's wonderful. It's caused everybody's return to be good. However, if you have less than average equity, it means that your ranking will likely be on the poor side. So your policy, or what the commission has decided over the last 3 years, is the best course of action for the fund to meet your personal obligations of your beneficiaries, has earned a lesser return than the choices of some other public funds out there. So that's a policy issue. And I would say the number one issue driving where you rank is going to be what your asset allocation is and how that differs from your peers. Now, I think it's useful information to have. You should always know where you are. I would not unto itself view it as a goal. It's very difficult to say I'm always going to be in the top quartile of the public fund universe, as an example. And I wouldn't even be able to tell you what asset allocation would earn that. I'd say over the long term, and long term I'm meaning 10 years, 5 years, and I know your rankings aren't good for 5 and 10 years, so that's known here, is to be above median, but risk-wise, to have a really good return and risk coefficient that makes sense. You don't want to be taking lots of risk to have earned that return. The people that are in the top quartile of that universe had a really bumpy ride over the last few years, might have done very horribly the prior 3 years. What we're trying to do is to earn something that's going to be a good return, a reasonable level of risk, and not worry as much about what your peers are doing, but what's right for your fund and this group and your staff, what are they all capable of doing, and what's a good asset allocation. So certainly, no one's going to be happy about a 98th percentile. That's not right. That is your policy benchmark. You've added a lot more value than that, but you're still below the median. I'm not going to make that sound like it's fantastic, but the execution of that strategy has been very good, and we believe that going forward, it's going to do a lot better in the universe over the next 3 to 5 years.
Well, of course, I hope so. Couple things. We benchmarked it, we benchmarked in the 1 and the 5 billion, BNY, Tux, same with different variety of years, and it's pretty consistent. And I agree with that. I
think so,
go back
yeah.
over 3 years. We always like to, when we do well with risk or salaries, we always want to benchmark against our peers. When it comes to performance, we don't. I understand this argument about we like to match our assets and liabilities.
Yeah.
Everybody does. And across the country, one thing we know is that everyone's aging workforce. Everyone has a workforce that's aging. No one has enough contributions. Well, I shouldn't say that. Nursing is very well funded. But many people don't have enough contributions, and of course, we're in a low interest rate environment.
Correct.
As far as the equity allocation, how much of that is picked up by the overlays? We looked at returns last night, and I'm not sure that we're all that underrepresented when you look at the overlays. I like those. So is that really as big a determining factor as you say it is? You look at our exposure from the equities from all the privates and the hedge funds and things. It's pretty substantial.
Let me pull this discussion back into the agenda right now. What we're talking about is what our PIC policy for the fiscal year upcoming will be.
Right, but the PIC fulcrum's off the policy benchmark.
But we
Right.
just for that, adopted the policy. Is there a motion that we change the policy benchmark? Is that what I'm hearing?
Well, that was, I had a question how it affected the calculation of this, right? Right, that's how we got into this discussion, right? Because we redefined the policy benchmark, right? And even underlying instruments that constitute the policy benchmark.
Right. Is there a question?
That's not affecting this particular program year for this year.
Right.
For the past year.
Right.
Yeah, it's a new year.
That's right.
But with the old or the existing plan, you and I served on the committee, especially the regular conference. But I won't belabor this, we'll move on. But what's important to me is I had no idea when we did this, none, that we would have a policy benchmark that's as low as it is. And I know we talked about this now. I'm not here to freak out. I want y'all to know that. We just end up talking about it some because it gets ignored. But I don't know how I go outside this room and say, we shoot for 95, if we make 93, we get bonuses. I don't know how I say that. And so it's a difficult thing. I think that a low benchmark creates perverse incentives. I think if the benchmark were different, if it were more competitive, if it was more in line with other plans, I think that you'd see that we would have our rates return.
Chris, I would ask, what would be the recommended benchmark?
Well, we hire consultants and you have a full business, full staff, and I'm kind of qualified to do this and apply. But,
Well, it sounds like you said you've studied it for quite a bit. And if we want to change the benchmark, then that's fine, we can have that discussion. But we've gone through months of discussion about the benchmark, the asset allocation. And I'm here today to talk about this, and now it's something we want to talk about
because,
again.
well, I
So,
want to talk about that benchmark since the EID, I voted against it, I lost. That's not my opinion. And I'm gonna lose this one too, I mean, I'm used to it. So I would like to respectfully say that I think that across the industry, and I went to 2 conferences in the last 6 months. And I asked and I asked and I asked. I couldn't find anybody who had something similar to us, where we had such a low benchmark, such a high target pay. Just couldn't find anybody. And I think it's difficult to defend from the labor point, and of course, I'm voting against this. And I think we ought to have a more reasonable opportunity for us to create true value. If you're at the 95th percentile, you've got 30,000 stocks and funds over there, you throw the dart, that's good odds that you're gonna beat that profile. And so I just, I'll end it with that. I think it needs to be, I love bonuses, I love incentives, I think it needs to be truly an incentive program, and this is not. Thank you for this.
If I may, if that's all right to add, I think it's an important issue, no question about it, as it relates to pay. I would say that best practice across public funds is to use as your primary measure of value added is how you performed versus your policy benchmark. Secondary, it is common to have maybe as a secondary metric or as a portion of compensation, how you did versus your peers. So that is sometimes a secondary benchmark, and then sometimes there's a qualitative, how well does the commission believe that staff has done. So we've seen those are 3 pieces, but almost always that performance against your policy is number 1, and it's generally, trying to get as long of a period as reasonable. It's hard, 1 year is common, but a lot of times they look at longer periods as well. Your policy benchmark, I can say with strong conviction, is reflective of the passive implementation of the asset allocation that's been adopted at this commission. It is a good benchmark. Its ranking in the universe is reflective of the fact that it's very different from other funds, and that didn't help you over the last year. There would be times when it'd be in the top 10%, and there's times when it's going to be in the bottom 10%. The important thing for the commission to be aware of is that because you have chosen a slightly different asset allocation than your peers, your rankings are going to be different. They should not be persistently negative, nor should they be persistently positive. But we believe over time it should outperform the median. I know that's difficult when we look at it now, when you're seeing a lot of numbers below the median, but we have conviction that that is indeed the case. And come and yell at me in 3 years if that's not the case. But it's difficult to project when that's going to turn. So as I completely understand the concern, but I would point out that what you're doing is accurate. We did look at the historic benchmarks. Obviously, we weren't here to create your historic benchmarks, but we did look at them. We feel they're accurate and reflective of the asset allocation we had. So are they exactly what we would have picked? Maybe not, but it's not meaningfully different in terms of total return. So I don't think there was any adjustment of the benchmark inappropriately or picking easy indices.
Well, nobody can think that either. It's just, it always goes back to the asset allocation. There's always, as you would spend a great little time saying that our performance is reasonable for our asset allocation and our expenses are reasonable for our asset allocation. It's just difficult to say, do we have, difficult for me to talk to experts, to talk to other people all around this country. And is our asset allocation good? That's why I really don't want to bring that up, so I'll leave that.
It being given that the commission voted on asset allocation and always will, and the staff is to implement in accordance with asset allocation decided by the commission, the issue is the recommendation that we award the performance incentive compensation this coming year, based on this coming year's benchmark, in the same way we did last year, based on last year's benchmark. And there's a motion to that effect in the Here we go, pass it down. Item, here it is. The motion, as I understand, is the PIC bonuses, the way they will be awarded for the fiscal year ending in 2014. Last year, the commission voted on the PIC bonus mechanism for which fiscal year 2013 bonuses will be awarded. So the theory of the government's policy, as I understand it, is you tell people in advance the basis on which you will be awarded bonuses. You don't make that decision when you know what's already happened.
Right. And the motion's in the packets.
May I ask a question?
Sure. Let's get the motion on the floor,
Okay.
then. Does somebody want to?
Well, my question doesn't necessarily directly relate to the motion. I mean, it's
Okay.
sort of, well, no, I mean, let's go ahead and address the motion. All right, well, go ahead.
I do have another question. There's supposed to be a report from that's mentioned in the policy support that talks about, there's a report that's listed in the policy that's supposed to come from the same. I think you find this one. My books got it.
That comes in all of those.
I think that's page 2 of the policy.
The Director of Operations and CIO will prepare a report for the commission detailing the financial impact of performance-related compensation paid each fiscal year, including the amounts, deferred payments, and any proposed salary or performance incentive amounts, both payout and assigned maximums. The PIC eligible senior management, provided, however, that the commission will be responsible for the compensation. So there's supposed to be a report with this that shows us how this plays out. And it would also be interesting to see what that report says that
Not at
the
this
budget
time.
request.
Not at this time of the year, Mr. Chairman. My understanding is that that report would get presented at the time of the year when the PIC amount has been calculated and is being presented to the commission.
That's historically what's been done.
I think that the commission would need to approve what the PIC policy would actually be for us to be able to make those calculations and projections.
Yeah.
And would you include in that report if we don't, if the commission doesn't receive its budget request, what the incentive program may, how it may affect the existing expenditures and things?
Could be part of the update.
I'll be glad to make a motion.
Yeah. As written in section 2A of the session motions.
Yeah. Should I read it?
That's not necessary. Okay. If anybody wants to read it, they certainly can, but it's not necessary. Is there a second? Yeah. The motion is the commission adopts the maximum PIC opportunity and performance award scales for fiscal year 2013-14 as set forth in the one-page attachment to Mr. Oliver's May 15, 2003 memorandum to the members of the commission entitled Appendix B Fiscal Year 2013-14 Compensation Plan Determinations Made by the Commission.
That's with the understanding of the sort of points that he made at the time, the actual incentive compensation is presented to us at a later date.
Yeah, this fall, the actual dollar figures for fiscal year ending June 30, 2013 will be presented to us. And then in the fall of 2014, the same thing will happen all over again.
Is there a second on the motion?
I'll say. Now, Alan, do you have more questions?
Yeah, I guess one of my questions, right, I mean, the PIC plan was originally developed with McLaughlin as consultant with the compensation policy, and I guess, I mean, what kind of strikes me during this, right, I mean, McLaughlin wanted us to kind of simplify, because we used to have sort of two things, right, so, like, I think to Suzanne's input, right, like, when you look at this, right, the execution relative to the policy has been pretty good, but there's no question that the policy choice, you know, which I think it's a little disingenuous to say that we kind of developed the policy. Yes, we ultimately approved it, but we certainly are doing that with staff input, right? shouldn't be part of the performance measurement. I mean, I feel like there's an incentive that's not being adequately captured by the current plan. So I just feel like the, plan, we need to go ahead and adopt what we laid out, with McLaughlin, but it probably behooves the compensation committee to kind of review the, pick incentive structures, right, to capture the policy effect as well as the implementation effect.
Yeah, I think that makes, to me, that makes always, it seems to me like one of the primary ongoing responsibilities of the compensation
Right.
committee is to constantly be looking at the
Right.
policy.
Right.
Any other discussion? All in favor of the motion, signify by saying aye. All opposed, by like sign. One opposed. Ayes have it. Okay. Distribution of commission evaluation materials. Who has those materials?
They're at everyone's.
Okay. Oh, they've already been distributed. They're in the typed up version of the folder, is that right?
Yes, sir.
And we're supposed to individually fill out that questionnaire form, discussion sheet, whatever it is, and return it to whom?
I'll compile it for you.
Okay. Return it, get it, you'll compile it, and I'm to look at it, and then we'll report back to the commission on it. That's the procedure that we go through.
That's right.
Okay.
And the excerpt from the policies and there with instructions.
Is there a time set by which I have to report back?
When the meetings were monthly, we tried to do it by the end of June, but now with the meetings,
So basically, the next meeting.
the next meeting with you.
Next regular scheduled meeting, I'll report back. And you will make sure that I do it. Where am I? Oh, one thing I wanted to call everybody's attention to, is that I asked staff at the end of the fourth quarter report for a more user-friendly report. And I came up with one, it's a new quarterly report that looks to me like it's a cleaner, clearer mechanism for showing our performance. It shows it annually, quarterly, and over time, which are obviously pretty good at this point. It gives some detail on our investments, but enough to be the current snapshot of the state of the fund itself. This is the first one, so I invite everybody to look at it and get comments back to the staff if you think it needs improving. I know that. I have instructed staff to discuss with Alan and other commissioners in advance of talking about our reporting. And some of those ideas have been incorporated here, it looks like to me. But anyway, this is the quarterly report that we'll be issuing for the quarter ending March 31, 2013. If people think it needs changing or revising or tweaking, let the staff know. Pardon?
Red 31.
Is that in the booklet anywhere?
Yes, sir, it's page red, it's red 31.
Red 30. Okay, I have the committee assignments, and we go bring up the other items, and of course with the agenda. I'm distributing those for the purpose of Article 6 of the government's policy says I'm supposed to, in consultation with the commission, make committee assignments, and I'll get to that in a second. But before doing it, Alan, you wanted to bring up
Well, I think,
Section 2 first.
well, I have a slight amendment to it, so I think first it needs to be proposed, seconded, and then discussion. I would propose the amendment, right?
On behalf of the ad hoc committee that I think has been dissolved.
You don't really need to move, it's a carryover. It's already been moved and is on the floor.
Oh, it
That's what
is on the floor.
it's
Okay.
saying.
All right. Well, I have.
Well, you're welcome to comment on it, but technically you don't have to move it.
Okay.
I had it printed up, so if we want to pass it around. I just have one proposed amendment that I think kind of captures it right in that I think it kind of formalizes it a little bit more in, sort of the consultations with the commission. It basically is to add a header over the section on the committee selections that the selections will be ratified by the full commission.
Is that in, policy 2B?
Yeah, and effectively, Dory, correct me if I'm wrong, but we would just add it as, at the top, right? Subject to ratification by the commission.
Right, if the commission should approve that, then policy 6 would also need to be updated under section 1B. There's printed copies, to be consistent if ratification by the commission is approved.
And the current policy says, I don't have it right in front of me, but as I recall, it says something to the effect, in consultation with the chairman shall appoint such and such. This would say the chairman shall appoint such and such, subject to ratification.
It's red page 42,
Red page 42.
has the draft
What's the draft?
that the committee, the governance committee is reading. And it's section B2B that's highlighted in blue.
No, it actually says in consultation with Vice Chairman CIO, taking into consideration requests.
And wait a minute, where are you?
B2B?
Oh, that's it, that's it. I'm thinking in terms of Article 6.
Yeah, no, we're looking at section B2B on red 42.
Do you still need the upon consultation with the commission at the end if you have that in there?
No, you wouldn't, right? Because presumably it would have already been consulted by the nature of the ratification of actions.
You agree, Dory? Okay.
This does just take it after the majority vote.
Huh?
Just, this is just a vote, so it doesn't really have to be consultation.
Right, that's right. I mean, presumably, right, I mean, for example, we have a slate of directors, and if we're all okay, we would ratify it, and if we felt materially different, we wouldn't, right? But it, I think it allows for the administrative thing, but, makes it a more formal process.
The only material difference that it would ever make is if in the case, if a chairman were to make a proposal for committee membership and it resulted in a free tie, then there would be no.
Oh, yeah, we got the even number now.
Where in the past, any consultation covered it because, a majority should always overrule. It leaves out there a potential for some future president to find himself in limbo with no committee.
It's kind of like a hung parliament, I guess we'd have to redo it, right? Come up with a slate that works.
There's not too many people fighting it on committees.
If this proposal is shown, it would have to be voted on. And the current policy is just, the chairman just consults with it.
Dory, correct me if I'm wrong, but I think our consultant, Hewitt on this subject, said that about half the plans have it this way, half the plans have it the way we had it in, in the proposed policy. So, it goes either way.
Right.
Preference.
That's right.
Okay? Did you get a second?
No, we've kind of been discussing it ahead of
This
time.
is your motion.
All right, that was my motion.
Okay, I'll second. All right. Anybody want to discuss it further?
Did you read it just to
Yeah,
make sure?
yeah, to read it. Approve the governance policy committee's recommendation for policy 2, chairman and vice chairman roles and responsibilities, but with the modification that the words subject to ratification by the commission be added at the beginning of section B2B, and the same words be added to policy 6 committees at the beginning of section B1 for consistency.
Okay, any further discussion on the proposed amendment to the motion? All in favor?
Does that include the idea that we're going to strike the redundant or unneeded language or because that's gonna.
Yes.
It's just gonna obsolete or make,
Yeah.
Yes.
make them necessary.
Yeah, I will amend the motion to include Dr. Pritchett's suggestion.
If the motion were to be adopted.
Right.
The staff really should clean up all the language
Right.
consistent
Right.
with the motion. Because it may be at somewhere in policy 6 other than at the beginning, but we might need some change. Okay. The question before the floor then is the proposed amendment to the committee motion with respect to ratification instead of consultation. All in favor, signify by saying aye.
Aye.
All opposed? Ayes have it. Okay. Now, we'll return to the agenda item, and I have distributed my proposed assignments to the committees. And let me tell you my thinking on it. For the audit committee, currently, I'm on the audit committee, Alan and David. I'm the chairman, and it seems to me that one of the purposes, not exclusive, but one of the purposes of the audit committee is to oversee audit matters and report back to the commission on how staff and the current leadership of the commission is doing on items that require audit attention. So it seems to me that it makes more sense for the audit committee to be composed of the upcoming chairman, the former chairman, and the representative of PIBA. Of course, the representative of PIBA by policy must be on it. It's sensible policy. But the people who, the incoming chairman needs to be attuned to these ideas, and the outgoing chairman is the person most knowledgeable on these sorts of issues. So I think that ought to be the audit committee. That's my thinking behind that recommendation. As to the compensation committee, the people most concerned with compensation, it seems to me, would be the current chairman and the incoming chairman. So that's that. And the reason for Dr. Pritchett would be on there, he's the representative of the retirees, and it's the retirees' funds who are being spent to pay these compensation issues. So anyway, that's my thinking. And when we get a new commissioner, it seems to me that compensation committee might be restructured now, and or I ought to come off of there. And the only reason I say that is it seems to me that the chairman has enough responsibilities, and to the extent we can get the chairman off of committees, the chairman ought to be off of committees and just attend them. And for the same reason that, does our policy still say that the vice chairman can't ever be the chairman of the committee?
No longer.
Okay, it doesn't say that, but that same kind of thinking, it seems, for the chairman to be wearing two hats is making committee reports and also being chairman of the commission is probably illogical. But for right now, I'm recommending that I Dr. Pritchett and Joe to be on the compensation committee for the reasons I stated above. And I would ask the commission to ratify that recommendation. Pursuant to the new policy.
Mr. Chairman, of course, you left me off again.
Well, you said you didn't want to be on committee.
No, that's not what I said at all.
You
Never
sent me
said-
an email and said you didn't want to be
I didn't want to be on the budget committee because the budget committee answers to staff. So let's not. On asset classes, on all these committees, and at every opportunity, I'm as far away from anything as I can be. Don't appreciate it. I'm here as an ex officio member of this committee. I come here by virtue of my office. I don't think it is appropriate for one person to say that people, the elected state treasurer, have no voice, you have to say, and that there's way too much power in the chairmanship, and I think there's enough spreading around of the committees, especially when you take into consideration the asset class committees.
Well, in addition, part of my thinking on the compensation committee, I don't think it's appropriate for politicians to be on the compensation committee, period. That's another aspect.
Well, I think that's appropriate for you to think. All I can say is, here, the elected no votes today, it is not fair and it is not just. Now, when I talk about things about a moral court, this is what I mean. This is automatically take and brings out one person, so you don't agree with it. I'm here to represent the people of the state of South Carolina. The Treasurer's Office has been here a great time, longer than this commission, and will probably be here afterwards. And I have to answer for everything I do, unlike the other commissioners. And so, not going to change unless the other commissioners step up. But I just don't think it's reasonable, and I think it's appropriate.
In my view.
Could I make one comment here?
Yeah, go ahead.
With all due respect, Mr. Treasurer, I object when you say you're here to represent the people of South Carolina. As fiduciaries, our sole responsibility is to represent participants and beneficiaries. Taxpayers that
North
end up
Carolina,
in your
somebody?
media
Are these
releases,
people- these
and
people
the
of North
people of
Carolina?
South Carolina, as you just said, are not part of the fiduciary obligation for someone to sit on this commission.
So the
That
500
really annoys me as a
Well, I'm sure it does,
participant and
Mr. Pritchett,
beneficiary.
and I would, of course, never expect you to help on these issues. 540,000 people in this system and the people who are coming into the system are all important to me. I
Absolutely.
understand our strict fiduciary responsibilities, but I am not here because of those other reasons. I was put here because of a specific position, as the next treasurer will do, and the next treasurer will do. And we appreciate that. I don't think there's anybody in this room in the last 2 years that's studied fiduciary responsibility more than I have. And out of my own pocket, I've traveled around the country to talk to experts. So I understand that. But that's not the issue at hand. The issue at hand is whether or not one person can just decide, he's a politician and state law will be damned, you're not gonna get a
We've
second.
decided that issue. We've decided that one person doesn't get decided, the commission gets decided.
Let's call for a vote.
As was just demonstrated, I feel that I cannot exercise my fiduciary responsibility and at the same time recommend that you be on a committee, and that's why I've not recommended that.
I feel I cannot.
It would be
I cannot-
inconsistent with my fiduciary responsibility to recommend that you be
It
on a
is
committee.
inconsistent with my fiduciary responsibility to have a man under criminal investigation as the chairman of the $27 billion fund. So I move for a vote. I've forgotten what I was saying.
I have already moved for the ratification of the committee. Is there any further discussion? All in favor, signify by saying aye.
Are we taking them together or taking one at a time?
You mean individual by individual?
No, the committees.
I don't mind splitting.
Let's split them, don't mind.
That's what you want to do.
Or just
All in
take
favor,
one.
all in favor of ratifying the appointments to the audit committee, signify by saying aye.
Aye.
All opposed? All in favor of ratifying the appointments to the compensation committee, signify by saying aye. All opposed?
And I'd like to abstain from that one.
So 4-1 with an abstention?
Yeah.
Okay.
Ayes have it. As everyone knows, we have an upcoming, one would hope, upcoming somewhat long into the future, need to appoint a retiree representative. We received some names and for various and sundry technical reasons. None of the names we received met the statutory or other qualifications for the position. So the commission still needs to entertain nominations for a retiree representative to replace Dr. Pritchett when his retirement becomes effective. I would suggest that we let the floor remain open until the July 4th holiday weekend. That is. I hope we can find sufficient nominations at that point. And if we get the nominations and staff can value for meeting the statutory and constitutional qualifications, and depending on when, who, and the other circumstances, we can either call a special meeting, or have a meeting in July. That's regular. Any objection to that procedure? And that, hearing no objection, that's what we'll do. Report of the audit committee now.
Yeah, so the audit committee,
Excuse me,
Yeah.
before I get that, Ed, you wanted to make a comment, as part of my. Chairman. Yeah.
Yes, I think if you all recall at the last meeting, I stated that I would resign from the commission at the end of this month, pending some resolution of the current situation that I regarded as really most concerning. In consultation with the governor's office, they have asked me to remain. We're going to have further discussion, but for the time being, they've asked me to remain.
I'm glad to have it. Well, the time, I can't speak for unanimous, but I'm glad. Now, Alan, let me turn it over to you for the audit.
Yeah, so the audit committee, obviously, you know, the notes and everything are available. I'll keep it relatively brief. The biggest issue for the audit committee,
Andrew.
I'm right here. Andrew, come here. I need to ask you a question real quick. Sorry about that. I'm just trying to confirm, because some of what the audit committee deals with, we've addressed in executive session, so I have to kind of confirm what's been discussed publicly. The biggest issue for the audit committee is we've had to adjust the audit plan due to resource allocations related to the issue we discussed at our last meeting in executive session. So that's probably the most material item to report from the audit committee. The materials are out there related to updates with the compliance program, as well as the audit plan, kind of where we stand on that, the Deloitte report, and the progress report there. So, the information's out there, but I'll keep my comments relatively brief, and I will have some additional comments when we go into executive session as an update.
Any questions?
Alan, no questions. I'm sure it's in here probably. As we move through and do a good job of creating these policies and trying to get them implemented, how do you create some comfort that you don't back something? You know, that if either you got somewhat, commissioners have to be on looking over everybody's shoulder, or there's going to be some process by which you certify things.
Right.
I was looking at some of the investment memos, and they're helpful in some ways, but is it y'all fault, or is there a practice in other places that you would say, the investment team approved this, and all the due diligence is done, and it's not everything that was done, every piece, but it would be a certification by somebody, but yeah, this has all been done. This is our normal customary practice, it's in policy, and it's all been done, that type of thing.
Right. Yeah, normally, again, this gets to the function of internal audit, right? Is, first you say, do we have the item, right? Then do we have adequate written policies on it, right? And then the audit is really about developing forensic testing, right? I mean, there are different modes of testing, whether those are observation, whether those are actual tests. And Andrew, you can speak more to this. I believe Monica's out sick, but yeah, I mean, that's a big part of the internal audit, is that internal testing. Now, you obviously can't test everything every year, right? And that's all addressed in the audit plan of what you intend to test throughout the year, right? So yeah, you absolutely would have those audit reports, right, coming up from internal audit staff, related to those actual, forensic tests that get conducted. Right?
I understand that part of it, but just say like, let's just say opioids. If we're looking at it, if we were interested in the due diligence, we'd have to ask 1,000 questions. There's a lot of work on some of the sheets and things. Or we could get some type of certification. Had y'all toyed with the idea of having the team leader sign off and say,
Mr. Office, you're talking about a certification from the investment team? Or
yeah, for the investment team,
because
or whoever's in charge of the...
Internal audit compliance does a completeness review certification, which has been discussed at previous meetings. I'm not sure if that's...
And that would be for each investment?
For each new investment.
And
yes.
would you just include that with the...
Yeah, it's been included in the past, but we can include it on a go-forward basis. It's a standard, just letter.
What I was trying to get
It's
at
part
was-
of the due diligence guidelines.
If we got, the summary recommendation memo, and you look at it, and it all looks great, and you can review, but you don't want to get into, so this is a little bit of an anomaly, so then you have to start asking questions, right? That's staff time, all that. we've got somebody such as this review that you already got, and I thought you probably had one, but that's attached, and I'm not asking for, the checklist, it's just something that says, hey, we passed all of this.
Just to preface, it's a completeness check. I'm not certifying to the investment side of it.
That's right.
I'm certifying to make sure that it's been complete, the process has been performed.
Yes.
So,
And would y'all be able to put that in?
Yeah.
That'd be a lot of help.
yeah. It was performed for all three of the investments on the agenda. So,
And Andrew will forward me the notification that he's fine.
that's part of the policy. It goes
And I'll
to,
just stick it in the memo and then we'll get on to it. Thank you.
so that is just to preface, that's not an audit. We will be doing a detailed audit
No,
of these.
no,
Okay.
wouldn't expect that, There's only two of them.
Well, and some of it, right, audit can only review things that have already occurred, right? Because the completeness check is actually a pre-investment activity, right? I mean, you don't have anything to get audit, right? An audit would go back and look later, right? Kind of a look back in time at, did they do that test, that they got the completeness check and different things.
These things are certainly staff that.
Right.
The commission shouldn't have much to say about it. But if there's not some type of certification, then you're bound to ask a question.
Right.
And it is ask a question, there's two more come up from that. So it would be very helpful. Thank you.
Yeah.
Okay, Mr. Cio.
Thank you, Mr. Chairman. I have a few brief remarks, and then we'll have a performance update that I'll ask Deputy CIO David Phillips to lead, and then Brady O'Connell from Hewitt will also give a few comments, and then following that will be the hedge fund definition. That was the discussion we had part of last commission meeting as well, and then we'll have several investment recommendations. First part of my comments would actually be recognizing Jared O'Connor. Jared has been with us for a little over 4 years now, and in August he will leave the commission as he will start his new endeavor of business school. So he's going to New York's University Stern School of Business. So congratulations to him, and thank you very much for your time here. So I appreciate it. My other two comments we've really kind of touched on a little bit earlier, some of which we discussion, and it's with reflect to clarification of the effective date of the asset allocation benchmarks starting on 7/1/2013 for their implementation. With that said, recognizing that there will be rebalancing, and so that will take approximately 6 months to reshape the portfolio. A couple of key areas is that overall, because we're taking down the portable alpha, we'll have a net reduction of hedge funds. So we will be liquidating hedge funds. Now, a portion of that liquidity is already in place from standing instructions for several managers that are in a liquidation phase that we had discussed several months ago in the executive session. So that in itself will act as a natural rebalancing tool for us, but there may be a couple more recommendations we bring back to the commission to further get us back in line with the policy. It'll take approximately a total of $800 million in reduction of hedge funds to get us back to the maximum limit of approximately 15%. So we'll continue to monitor that and update the commission on what that transition will look like. The other noticeable area is we implement going to the active benchmark. And if we take a look at breaking down that composite into its various, the U.S., the developed markets, and emerging markets, you'll find that we have significant overweight to emerging and underweight to the non-U.S. developed. So we may make some rebalancing tweaks in that component as well. Right now, it's about, each side is off about 3–3.5%, so it's still within the policy target ranges. So we're still fine from that aspect. Also, cash right now, we will significantly reduce cash, but the vast majority of that cash will be used as the collateral replacing the portable alpha structure for the overlay program. So we'll see that cash number, that net cash number come back down significantly as well. So those are some of the changes that we'll be working through as the 7/1 effective date approaches.
While you're talking about benchmark, talk about one thing. Have you received, or we received some kind of report from Boney that says they don't like our benchmark?
That's not what they said.
I have not.
That's not what they said. Would you like it? I thought we should have done something.
Who's they? You said that's not what they said. Has Boney told us that they do not like our benchmark?
No, you said that. Benchmark.
My question was, have we received it?
We haven't received anything from Bank of New York stating that they dislike our benchmark.
Yeah, and they would never say that. It is an academic exercise that's done completely by computer. It's, Russell, please don't call me this. Would you like me to send this to you? I'd be more than happy to, but it's not a pejorative, this is just what it is. Or if you'd like, we could ask Ms. Bernard.
What I'm trying to ask, what are we talking about?
I have no idea.
I have no idea what we're talking about here. What are we talking about?
I thought I heard somebody say that Boney said that they didn't like our benchmark.
Nobody said that.
I thought you said it. Am I wrong?
No, sir, I didn't say that at all. I said the benchmark is in the 90th percentile, which is very different from saying they don't like it.
Do we have a report saying Boney thinks our benchmark puts us in the low percentile?
That's on page, what, 61
We
in
don't have
red,
a
right?
report from them that Bank of New York's making a statement, but the Bank of New York universe reflects the current ranking of that.
Okay, so we're talking about Bank of New York ranking, not their evaluation of our benchmarks.
Correct.
Right? Okay.
So those were really my brief comments for the CIO report. If there aren't any other questions, then I'll turn it over to David Phillips for a performance update. And Mr. Phillips' presentation will start on red 47.
Mr. Chairman, we'll start with some performance highlights from the March flash report. So my comments are going to focus on fiscal year to date, first 9 months, ending in March 31st. Fund has returned 11.15% for the first 9 months, which is 228 basis points ahead of policy benchmark. Just as an FYI, through May 20, a couple of days ago, fund has returned, just bring it current, an estimated 14.9%, which is 273 basis points ahead of the benchmark. Bottom red box here, bottom red box here, just note that we are roughly in line with policy target weights established by the Commission. And in the top red box, these are market returns for each of our asset classes. 3 observations here, and the purpose of going through these is just to bring out some general observations for everyone as we see them on the staff and as we review these reports as well. So several observations. All 4 equity categories in our policy are producing double-digit returns. 10 asset classes are tracking ahead of our actuarial rate of 7.5%. And the weakest return-seeking categories are the commodities and global fixed income categories. Overall, just from a market perspective, these are some high bars for staff to achieve if our goal is to outperform the market. Second page of the executive summary from the flash report. Top red box here is our actual fund category performance. Observations here are all but 2 categories are ahead of their market benchmarks. 10 categories have posted double-digit returns. 3 of the 4 equity categories have exceeded 20% for fiscal year to date. And alternatives as a group collectively has posted double-digit returns. Commodities and investment grade credit both are relatively negative comparisons to their benchmarks. And the commodities category is the only negative category on an absolute basis. And in the bottom circle here is the dollar value added as a result of performance numbers above, and I'll break those out in more detail in the next few slides. So slide 4 here, page 4. This is dollar value added by asset class. Commodity exposure here, as mentioned, was one of the weaker items. Commodity exposure is broken out into 2 sections. This is the active manager The red component here, small component, this is the active manager contribution. And the rest of the commodity exposure is in this overlay category, our index exposure to Dow Jones UBS index, passive implementation. I noted previously that portions of the fixed income categories are relatively weak, but I wanted to highlight here that as a group, again, overall, fixed income category on an absolute basis is a positive contribution, even though the relative comparison is at the bottom of the list. So another perspective on this on the next slide. It's a graphical comparison of each asset class to the policy benchmarks. So if I draw your attention first to the black bars on this chart. The black bars are the relative performance numbers for each category to its benchmark. On the right side of the chart here, you'll see two negative black bars. That's the commodities and the global fixed, the investment grade credit categories. And with the red bar here, you'll see that, again, commodities is the only absolute negative performer for our asset classes.
Can you explain to me a little more about what the relative performance means?
Absolutely. Several perspectives or explanations to that, Mr. Pritchard. One is each of our asset classes, we establish a policy benchmark to which we've had some discussion on this morning. So the performance of each of those policy benchmarks here are in the gray bars for each, and then these are each of our policy allocations as approved by categories, as approved by the Commission each year. So green bars represent what we actually perform in as the fund in that category class. The gray bar is the passive implementation of that as if we were to make no active decisions in that category. And then the black bar is the difference between the two.
I thought that's what it meant, but some places I quite see it.
So maybe some confusion is here. The relative performance here is negative with investment grade credit. So the market is outperforming our fund in that category. Here,
The black, if you put the black there on top of the green, it ought to be exactly equal with the gray.
black on top of the gray.
Right.
Right, correct. Black plus gray should equal green.
If it's negative, and if it's positive, would be
No, if we stack black and gray in every case, it should equal the green. I hope that's visually apparent. Okay. No, no.
That makes sense to the math world. Another way of thinking of it is if you take negative black and add it to green, it would be correct.
Take the absolute value of black and add it to So, just as, if it's not apparent, obvious comment here is this is an extraordinary circumstance. Everything is positive almost across the board here, and we're quite pleased with it. I don't expect to be able to show you this on every case going forward as an update, but this is a pleasant outcome for sure. If I refocus you here on the green bars for just a second, just to highlight the equity market performance. The tallest green bars across the tallest categories, really across the middle section of the chart here, are our equity categories. 30% of our fund is allocated by policy to these categories. And just in terms of optimal allocation, with hindsight here, we have 30% allocated to these four categories, which are the strongest performing categories. We have 2 and 3% allocated to the weakest categories here each. So in terms of optimal allocation, those are good decisions. So that completes kind of the So that completes kind of the high-level asset policy, review. Just pause there for just a second, see if any questions on that. Yes, sir.
When we have historic moves in markets, like what's happened in the Nikkei and the dollar yen, how close, we had one last night, what was it, Alan, you followed us 7% last night, 7. Do we, like Johnson and some of these people, Jeff, how closely do we look at that when we have, and these, I mean, the dollar yen move and the Nikkei move have been historic. I mean, how closely do we monitor that, I guess?
We try to aggregate that on a policy level, and we've got some figures to that we can discuss. The real analysis or monitoring part of that, Mr. Powers, is more on the manager level. So we're cognizant of and we monitor where each manager is exposed. We make a fairly good attempt to aggregate it and track it. Just as a for instance, we'll get to this here in more detail, but just as for instance, you'll see the negative performance fiscal year to date again to Mondrian Global, negative 2.4%. Of our largest allocations in the fund, this is the only negative performance that stood out. The reason for that is the Japanese exposure in the global income, the global fixed income category.
And we took a look at that negative 7%. About a third of it came from currency, and the other 2/3 came from market impact.
Definitely
Well,
interesting.
you're watching much more closely than I am, if you know those statistics, but that's fine. Thank you.
Jim, I think it was never recovery after that precipitous drop.
Yeah, but they decided, fix the question. It was historic.
Oh, yeah.
So moving forward, we wanted to begin sharing some line item contribution detail with the commission. So we're starting here we have 2 slides today. This one is showing the top and bottom 15 contributors to the fund on a fiscal year-to-date basis after filtering down to current and meaningful, which is footnoted on the slide, items excluding cash, of course. So several observations here, just to take you through the detail. Of the top 15 in green, of the top 15 highlighted, color-coded in green here, 1 through 15 top contributors. 6 of those were external equity managers, and 5 were alternative/hedge fund allocations. So within, again, our major allocations, from a policy perspective, those are contributing quite nicely. On the bottom 15, first note I want to bring out here is red is not necessarily bad. Red is the bottom 15 relative to the top 15. You'll notice the numbers here, contributors in the red category are basically 0 and negative few basis points. If distribution of our returns stops at 0 across all of our allocations, I think that's a relatively good outcome. And I'll take that every time. So this is, we always want these to be positive, but again, with 95 line items, these are not bad numbers. 10 of these in the bottom 15 are private equity or private debt. So I'm going to qualify this list, I guess, with a couple of qualifications, footnotes, observations. The numbers coming in for these managers are not necessarily the most timely numbers due to the fact that they are private equity, private debt type of structures. So given the nature and timing of the performance update, these tend to lag, I guess, historically. These are time-weighted returns, which are not necessarily the most preferred way to track these from private equity category. And then also note that this is a mix of funded funds and secondaries, so these tend to move in a very nonlinear type of fashion. So another perspective for line items on slide 7 here. This is a list of our largest allocations. The cutoff is 1% allocation of the fund, or $270 million. There are 31 line items. They represent, they total to $15.5 billion.
approximately 58% of the fund. So intuitively, these should produce the most significant, hopefully positive contributions to fund performance. A couple of things to highlight, breakpoints 1 through 8 basically is 500 and above. Average market value over the time, or average allocation over the time period for what we're looking at here. And then 1 through 19 would be 300 and above, $300 million above allocation. So just a couple of arrows to help, just to kind of help focus, how to use this chart. Top arrow here, you'll note we have a large weight, the largest weight, with weak performance, but because it has a large weight, we still get, or are we getting a mediocre contribution to the fund. So this is not necessarily rank ordered here, it's ranked by the weight in the fund. And in the second arrow, you'll notice very strong performance, but a much lower average weight, 1.7 versus 5, and you get a higher contribution to the fund. So this is, again, a new perspective we'll bring in. We intend to expand upon it and monitor it, highlight a few of these things on an ongoing basis. Touched on monitoring. I had a note to talk about this one, but I did that already. So monitoring, one I guess, impact of using these things is that it helps us to ask questions. There's one negative return in the top 31 contributors. It was monitoring, and Mr. Powers, we addressed the reason for that. So we'll pause there for any questions before I skip to the new topic.
How do you anticipate this information will prove to be useful? Is that a working process?
A bit of a work in progress process, but one is it's an FYI for you, for the commissioners, to know on a line item basis, which I think is something new, really calling out and highlighting, what, for instance, our largest allocation at PIMCO fixed income here is 5%. What does it do and how is it impacting? So a bit of it's an FYI. The other is, to the monitoring point, it's useful to us and to staff to say, hey, what's going on there? And go back in and see if it's something that we need to address. And it's an indication of whether we're being successful or not. This is 58% of the fund.
I like the information. I'm just wondering if we develop a systematic way to actually use it.
I think the next iteration of this would be to monitor changes in the composition of the top 30 line items here, or whatever the cutoff is. We would monitor the change in the in the weightings here over from one quarter to the next, or year-over-year basis. See what comes and goes and why.
I think that another iteration would be, then, this is more capital allocation. Think about from a risk weighting perspective as well, and take a look at it from that perspective as well.
Switching over to a new topic here, or a different topic, shouldn't be new to anyone, I think. So risk management, risk reporting are priorities for us. It's probably more priority for me as in the deputy role to make significant progress in these categories in both monitoring, measuring, and managing this category. So collectively and individually, we are very focused on this topic. We started earlier this year with refreshing our best current consolidated report for risk management, which is a Goldman Sachs risk report. I know many of you guys have seen it. It's an extensive report. There's a lot of effort, data, and analysis that goes into that. It is based on composite time series return as well as our current asset allocation. So a snapshot here taken from actually year-over-year report as of March 31 ending, our most recent one this year, and March 31 of 2012. We see these comparisons of the changes from one time period to the next. So from left to right, again, this is 2012. We see an increase in expected total return for the portfolio of 60 basis points from 7.3 to 7.9% year over year. We see an increase in risks for the portfolio of 11.4 to 11.7, so 30 basis point increase there, which is a good trade-off because it improved our Sharpe ratio from 0.47 to 0.51. So decisions that we are making, have been making, continue to hope to make, to improve, to accept this trade-off and create this trade-off where we have disproportionate increase in expected return versus the risk we're taking, something that we've talked about a lot, we're focused on, and hope to continue to demonstrate that.
Yeah, Dave, ask a question. Second line, the total risk, I think, did you just refer to that as total return? Second line, total risk 11.4.
If I did, I misspoke. So total risk is 11.4. It was 11.4 in 2012 and is 11.7%. Risk being volatility. Okay.
How does that compare to what we've laid out in an asset allocation plan? I mean, those numbers, I mean, are what we're measuring in line with what we expect? And then, I guess the other question is, how much of that move in expected returns just because we have more equity in the ground because equity markets have gone up versus actual active decisions and changes?
Yeah, this is all off the pure expected capital markets assumptions.
Right.
That are provided to Goldman Sachs to run that, so it'd be a combination of what NETC had historically,
Yeah.
and any changes from those time periods, and we updated with the capital market assumptions from Hewitt at this point, so they have those incorporated there as well. So that's where that chance of the change in that expected forward-looking return and risk is coming from as well. So that's being baked in from the year-over-year look.
It's different processes, but I think you'll find that the results of each process roughly, true up are roughly comparable with what Hewitt has shown.
So those numbers then are being derived from our inputs, not marketing inputs?
Right.
Right? Okay.
So they're not going to be a real-time update.
Right.
I'm sorry, Herschel, not going to be one.
A real-time update.
Just to make sure we understand, what's the difference between the column that's circled in red and the column that's not circled with respect to each year?
The portfolio versus the policy on the target as an element.
So the target is policy and the other is actual.
That is correct. Yes, sir.
And so you could read that as given our policy allocation, this would be bullseye, 100% accurate implementation, and versus reality, we'll have implementation drag over and underweights to our policies, that type of thing. I was pointing to 2012, so same would be here in 2013. And again, don't recall the expected return for our asset allocation. I think it was in the high sevens. Is that right? And we're showing 8% here.
You say that's coming from Goldman?
Goldman does the analytics.
Do we, through they, have any ability to come up with a real-time market estimate of that? Like looking at forward markets to have an expectation, like a forward expectation versus what we've input into their expectation?
We would.
I mean, through forwards and options and.
Put in the forward expectation. We could work with them to do that, but currently the way we've set it up is that we'll take a look at a static, what we provide them with capital market assumption basis. We can work with them to come back and actually use what they're seeing in the market and update those.
I think it'd be interesting to have it in there.
Dave, could you just discuss a little bit about the last two lines? You got value at risk 1 year and then value at risk 1 year.
It's a 95%
Right.
confidence interval.
So 95% is within 95% confidence. We can say that our worst potential drawdown is 10.2%.
Of the total portfolio?
Correct. And with 99% confidence, which takes into more of that tail possibility within the return distribution, you see the jump up to 16.6% worst case. Forward. So sticking with March 31, 2013 now, from the same, the most recent report, this is a factor analysis breakout, again, from the Goldman report, predefined market factors being global equity, change in treasury spreads, change in exchange rates, change in commodity prices, and change in absolute levels of treasury yields. And bring this to your attention, it's not new, it's not new information to us, it's been consistent for some time period, but again, equity risk is the by and large the main and almost only primary area of concern from a factor-based analysis. So, to tie this back to the asset allocation decisions, we have 30% capital allocated to equity, but a risk allocation is more like 70% of those two changes in the equity market. So, rolling to the next topic, or segueing into the next topic, this is really the reason why we take periodic action in to manage that equity risk. So, especially given the positive performance that we've experienced on a fiscal year-to-date basis, and on a year-to-date basis, we're cognizant of the need to protect the gains that we have. So February and April were the most recent transactions that we did in what we call hedging, downside protection type of activities in the portfolio. It's a very complex topic and scenario analysis associated with this, so I've tried very hard here to just simplify a few things. The concept is that we're willing to pay some premium, an insurance premium, if you will, to protect some of the downside risk exposure that we have in the portfolio. These are specific to equity market risk. So as a general rule, that premium that we would pay is expensive, as you would guess. So we try to offset it. I'll go through some of that here in a second. February, we put on a collar tied to the S&P. February 15th, we put on the SPX collar as noted here. Buying an out-of-the-money put and selling an out-of-the-money call option on the S&P. This established a floor on $500 million of notional at the 95% strike price, so we effectively capped the negative impact from a downside move in the S&P at 35% applicable to the $500 million notional here.
What was the cause of that?
The cause was just a proactive risk mitigation decision on our part for
Cost.
I'm sorry, cost. Cost is here. Cost of that would be, of this collar, would be the sum of these two numbers here, so roughly $3 million net cost.
Net.
So the put cost us $5.8 million. We sold the call for $2.8 million. So the net of the two was the cost of that position. Going forward in April, we did roughly the same thing, except we took some basis risk between the markets here. We sold the put on the S&P at 97.5% strike, capping our downside risk tied to $250 million of notional at 2.5% negative move in the S&P. We financed that. We paid $4.3 million for that position. We financed that by selling this call in the CAC, which is a French index, the primary French market index. We sold the call here out of the money at 103 and received $2.7 million in premium for that. Again, that was on the second one was on $250 million notional. These overlapped until last week. The top one expired on May 17th last week. They overlapped, so providing cumulative protection for $750 million for the time that they overlap. The current one is still live, if you will. It expires June 28, roughly 35, 36 days left on that one.
Who does that for us?
Russell implements it. We generally, we have advice and guidance from them in terms of what potential trades, market positions, premiums are. We ultimately make the decision here internally.
Russell's such an important part of the portfolio. How often, there are a lot of trades, so we all have to make these decisions daily, multiple times a day, or is it, how can we reset?
These are, if you take a look at when the trades on, they're roughly a couple months apart. on an evaluation perspective, it's something that you do monitor, but you're also monitoring the levels of volatility in the market. So when you have lower volatility, that tends to be the areas where the timing of when we would want to enter into hedging some amount of notion. Keeping in mind that on 30%, some $8 billion portfolio, we're not hedging $8 billion of equity risk. We're taking a smaller notion of pieces of it. And then the staff, we will discuss these, input from Russell on the pricing, the timing, and if we want to, want to trade or not. But we're not trading daily. We're not having very active. These are going to be hedges that are very selective and more than likely, in most cases, they'll be held to expiration.
Is the sizing on these, I mean, do y'all kind of forward project where we are relative to asset allocation? I mean, let's just take our benchmark at 30, right? We're in a Ripon equity market, now we're at 36, right? So in a normal cash transaction, you're selling 6 and buying fixed income or whatever else. I mean, are we looking at the sizing of trades like this and the structure of trades like this, right, relative to where we are in relationship to the asset allocation or structure? Just because obviously someone calls your capping upside, right? But because we're a natural rebalancer into down markets, put spreads, don't cap your upside, accomplish the same objective, but also in line with the way you would reallocate assets. So
Combination of that and also expectations of the market has been running very hard. I think it's up some 40+% from the lows in November, October. And at some point in time, you do expect there's got to be a little bit of pullback. So a portion of it is we want to be very cognizant of. You recognize you can't fully hedge the $8 billion. It's just too expensive to do so and give up so much of the outside of the plan you've already earned. So it's really an expectation of forward-looking where we expect the markets to be going. Capturing and preserving some of the risk premium you've already captured because of the rally, and then thinking about where you have in the asset allocation as well. So it's a combination of all those together.
yeah, I mean, really, should the size be related to how far we are off of the rebalancing benchmark in terms of sizing, not the $8 billion?
So,
Right.
and we're pretty close, and that's one of the reasons that we're seeing you're not seeing a lot bigger, because you lag into these and you take a look at when are these expiring and having a little bit of overlapping exposure. So you went from about $1.5 billion of total gross, which on a net basis would be much smaller. Exposure to the fact that it's only there for a moment, and you have one rolling off, and you still have some protection in place. And so we attempt to make that timing as well, that you're not overly hedged. It's really truly trying to focus on a portion of that left tail.
The further point with respect to these in particular, and by the way, we've looked at those, we continue to look at those natural rebalancing deals where we would actually buy into some down market, when that's appropriate for us. We price those on a regular basis. Also, these and this type of strategy, any one of these by themselves, you could argue that it's not meaningful to the $8 billion, but when they overlap, they become equal. And the concept would be to kind of on a rolling basis have that overlap dynamic happen.
You get the diversification of some of the tenor strikes.
Well, and some of this, I guess, and this is more almost a compliance and policy question, right? And this is effectively internal management within the context of rebalancing, right? What sort of written guidelines, and I guess this is kind of thinking back to the pre-trade compliance and sort of putting my compliance hat on, right? I mean, do we need to go, have documented policies and procedures around these types of trades, parameters?
Again, I would say this as well as just really rebalancing. I don't know if there's broader language and more specific detail language you'd like to develop, we can do that. But we keep it, monitoring with respect to the asset allocation of those ranges are as well. And think about that on a gross basis. So, but if there's something more detailed policy perspective, and I think that would tie back into November, we talked about internal management, a little broader. We're talking about bringing the equity internal. And I think that could be expanded, I mean, that, those policies could be expanded. Jeff Berg is working on some right now to upgrade, make some revisions for the fixed income component as well, so we can add that to his to-do list as well.
So, going to the other point on the slide, contribution to the fund on the right side of the chart. The 10 basis point from the February structure is fairly accurate. This was done before the expiration date, but roughly 10 basis points total fund from the first one, roughly 8 basis points as of, again, last week on the SBX impact. So the financing decisions here were, to sell the calls, and given what the markets have done, which has basically gone up across the board, across the world, with the exception of the Nikkei last night. And the implication is that our financing charge, if you will, went up with the markets, which again we knew that going in. You can see that better here. This is the February position day that we put that on, and this is the April day that we put that on. The red line is the CAC, so with respect to the CAC position, we put that on somewhere in this range, and the CAC has subsequently gone straight up. It rolled over, or is rolling over today, so we're going to benefit from that rollover in that position. The blue line is the S&P. Both of these had an S&P component to it. The first one had the call position sold, so you can see the S&P go from here to the top right. That's roughly a 10% move in 3 to 4 months time period. So you can see the impact there. Volatility on the bottom here has been roughly flat. It continues to be at historic lows in 12 and 13 range. Imagine this spiking today, but it's been low, and this is a primary input to pricing up these hedges. So when that number is low, these hedges are cheaper on a historical basis or a relative basis. I believe that's all I have. Any questions? I'll turn it back over.
So next up will be Brady O'Connell from.
Before you go on, I just have one other question. When you undertake these hedges, I guess my question is, do you feel or do you do any work to ensure that this is not in any substantial conflict with what any of our managers are doing, so that we don't wind up with us doing something totally out on an overall basis of what they're doing, so we wind up with a far different result than we expected? How does that work?
If you think back to the aggregated risk perspective that I put up a few slides before this, with the vector analysis, those perspectives are relative to total fund, regardless of what individual managers are doing, really. So these, in terms of an overlay, if you will, or of a risk management action, really regardless of what any individual sleeve is doing within the fund, this is meant to impact that aggregated level. It's helpful response. There's no question that there's going to be equity managers that we have that are long the S&P, and we sold the call and have our side. Absolutely, that's going to happen. But does it matter? From here, we're going to get the performance basically, so we get the spread, if you will, of what that manager is producing for us versus what we took off the table by selling that S&P.
All right, I will be relatively brief for a couple of reasons. One, a lot of this is redundant with what Mr. Phillips just walked us through, so I'll try to skip that. And two, just so the commission knows, we're going to be revising this report a little bit to reduce some of that redundancy and also make it more kind of compliance focused. So, Commissioner Gillespie, perhaps to get at your question, one of the things we think it's important to look at is where you are in terms of asset allocation relative to the investment policy target. So here on slide 4, we know you're pretty close, particularly in the public market asset classes, and that's not a surprise with the overlay program in place. Your physical exposure to equities and bonds combined with the overlay gets you really close to the policy target. So as a commissioner, you should know that the staff is implementing the target asset allocation not only within ranges, but also very close to the policy targets. Come July 1st, 2013, we'll update this to include the new asset allocation. And when we look at your historical performance, we'll also update the performance benchmark to reflect the new benchmarks that are included in that policy. This really reflects at a very high level the news that Mr. Phillips shared, very positive relative performance over longer periods of time.
Can I ask you a question, please?
Yes, sir.
We'll take 30 seconds to explain to you. Look, on slide 4, the total fund asset allocation. Allocations are above our adjusted to the overlay exposure. Is that also Russell? Or is
Right,
that?
that would be Russell.
And how often are those decisions? I mean, because really, if you think about it, you almost will never be out of balance with one of the things. But how often are those made? And if we had a very large contribution from the overlay, would you note that it was unusually large? And there's something happened, like it was a big one overnight or something. Would you ever say that that allocation is exclusively or significantly provided by the overlay? Or does it matter?
Yeah, the overlay is really, when you think about that, it's really getting the beta exposure for those markets to keep you back in line with respect to, say, for instance, public equity. So you have a futures or swap position on the Russell for the S&P 500. That in itself looks going to be 6-month to 1-year type tenors, or they can be varying, which depends on what the pricing is. If it's a futures market or a swaps market, it makes the most sense. As far as it's more of a rebalancing decision, could be from selling a manager, pulling a manager's allocation down and reallocating elsewhere, or it could be less expensive and make sense to actually implement a little quicker using the overlay. So maybe you want to add to a futures position to the S&P to get you back up, or take that back down. Those discussions are held pretty much weekly internally. Now, the actual implementation of it itself is, do you have a rebalancing decision coming up, so maybe a swap or position is going to expire, so how do you want to re-implement that? I would say that roughly 8 times a year, you'll probably, my guess, over here, it just depends on the market environment, how much you need to rebalance, when do you have swaps coming up for expiration, and you need to make a decision if you want to do a 3-month, 6-month, 1 year, those kind of things. But it's really meant to be, static's the wrong word, but it's not a day trading type phenomenon.
And this is done like the other overlays that in consultation with Russell.
Right. And back to those policies.
I could add one thing. In our full performance report, which is included in the extra net, it's over 100 pages, so we're not going to go through it here today. We have a detailed asset allocation summary that shows where all of your exposures are coming from. So it would include the Russell.
Just a quick point here. We do show the universe ranks, which we've discussed already today. When we think about helping fiduciaries oversee a portfolio, we do tend to separate the decision on how you did relative to the performance benchmark, and then of secondary importance is how you do relative to a universe of peers. So this, we already talked about how the asset allocation is done relative to other peers, and then how your staff has done implementing that asset allocation.
Explain the color coding of the bars.
Yeah, so this is just the percentile breakdown. These are the different quartiles. This would be the first quartile, second, third, and fourth.
Okay.
Really no oversimplification.
Each one is quarter.
Yeah. We illustrate this in another way, plotting the risk and return. So, one of the things we've talked about in meetings past is trying to measure the risk-adjusted performance of the plan relative to other plans. So what we've done here is taken the rate of return, which we showed you in a bar chart, but also plotted the standard deviation of your peers. And this shaded area just represents where the majority of those plans fall. And what I think is interesting and hopefully consistent with what you've heard in the past is for the 3-year and for the 5, your return has been low. We've talked about that, but the standard deviation or the risk that was taken to achieve that return is also very low. So you're farther to the left on this annualized standard deviation scale. And this is a scatter chart to show you kind of where they fall out. And you know, there's some outliers, but in general, if you take on more risk, you should expect a higher return from a standard deviation standpoint over longer periods of time. We thought it would be helpful to try to show some other measures of this and do it in this kind of universe quartile breakdown. So what we've shown here is the return for a 5-year period, just the risk, and then these risk-adjusted return measures. Sharpe ratio, which is just the return of the portfolio minus T-bills divided by the standard deviation, and then Sortino ratio, which is similar but uses a measure of downside risk, just not overall volatility. And here again, if you look at the standard deviation number, in the top quartile of risk, where top is low risk. We include a very high-level summary of the private market portfolio, including on the far right-hand column a net internal rate of return for the private debt, private equity, real estate portfolios. We do also provide the Commission with a comprehensive report on the private market portfolios. That does contain some information which is confidential, so this is very high level by design. And then just some comments on the number of commitments and what kind of multiples and net internal rates of return for that part of the portfolio. Here is the giant one, but I will show mercy unless somebody has questions.
Stretch, so it's okay if I stand up for our section. So I was going to go into hedge funds. Is that all right with everyone? So at the last meeting, we spent a lot of time on investment policy, on the asset classes definition, what your targets are, et cetera, and there were some very good questions asked about, okay, so we've had a lot of discussion about hedge funds. Let's narrow it down to a little better definition. So what we tried to do here in this brief piece is to define what a hedge fund is. That may sound obvious, but it's not as easy an answer as you might think, and Gary's probably smiling because I'm sure he's dealt with this before as well. So I think it's important that if we have an overall fund maximum to hedge funds, it's important for us all to agree in advance what a hedge fund is or is not, because it is a little bit in the eye of the beholder. I've seen people call certain products hedge funds, and another investor might not consider it a hedge fund. So we want to be clear there. And then secondly, we also want to make sure that we're clear on what the risk parameters are going to be, particularly for this absolute return component. So let's drive. Thanks. Okay. So just as an overview, obviously the changes that were recommended was to set an 8% target explicitly to hedge funds, and the intent was for that component to be a low beta exposure. So it's not going to move in sync with the stock and bond market. We want something that's going to protect, earn a good absolute return over time. Not all hedge fund investors have that same goal. Many want to have a higher return, and they're willing to have a little bit more stock and bond exposure. We're saying that in addition to that 8%, you can allow the use of hedge funds and other asset classes if within those asset classes the manager has a fair amount of market exposure. So let's think of equity long-short managers. When staff is thinking about how best to affect outperformance relative to a global stock benchmark, we're saying let equity long-short be in that opportunity set, but they're going to have the same tough benchmarks as long-only managers, and it's up to staff to decide that. But let's set a maximum to make sure that we don't have a loading up of hedge funds in the program of no more than 15% of the total value. Now that's a maximum, I want to be clear, that's not a target. The only explicit target is this 8%. I just want to mention we are eliminating that portable alpha component, which was largely being counted in the global equity. So it's going to be really clear going forward, where are our hedge funds? We'll have the explicit component, and then we'll have that maximum that we'll report on, so you can know where you stand. Now, you are higher than that 15% number right now, we believe. So it's going to take a couple quarters to get down there, because it doesn't make sense to go out and wholesale get rid of stuff. Some of these take a couple quarters to move out of, and you obviously want to be discerning as to where you make those changes. So what we're trying to do here is make sure we're on the same wavelength in terms of risk parameters. Make sure the benchmark issue is resolved. I don't think we have to change the benchmark, but I have two choices for you there, and we'll get to that. And then making very clear what is and is not a hedge fund. So that's my goal for today.
Does the 15% maximum include the 8%?
It does.
So it's 7%.
Right. It is technically possible there could be something in the hedge fund component. Everything in the hedge fund component is going to be considered a hedge fund. But you may have things in other asset classes that are hedge funds, and that's where we want to capture that. So credit, for example, that's somewhere you might have things that classify as hedge funds. Equity, other areas. So risk parameters. Risk parameters are an interesting thing. How do you define hedge fund risk? One of the ways that we look at it is, do they behave like other asset classes you already have? Because one way to risk up your hedge fund exposure is that it moves in sync with the equity markets or the credit markets. And that's okay to have, but we don't want that in that absolute return component. Its explicit element in the program is to stabilize, to not behave like other things, to be a diversifier, but to earn a good return over time. So what we're suggesting here is that you use as your risk parameters beta measures. Okay, so it's sensitivity to market movement. And here's how we suggest measuring it. If you look at a normal, kind of well-diversified hedge fund program, most of them have equity market betas in the 0.4 to 0.6 range. So the way to think about beta is if the stock market goes up 1% and you have a beta of 0.4, you just due to beta alone, you go up about 0.4 instead of 1%, so 0.4%. And if the market goes down, you go down 0.4 rather than 1%.
When you talk about that measured beta, you S&P 500.
Right. So what we want to use is a global stock benchmark for your equity beta here, because hedge funds typically will use U.S. and non-U.S. exposure, so we want to use the global stock market. And we want to look at it as a historical return beta. So what we're going to do is, if you look at it on a manager by manager basis, it's fairly simple to just look at their return series historically and look at the manager. Return series and the index, look at the last 36 months of returns and what is the beta relative to the benchmark. Okay? So what we're looking at is when you roll all that up for your component, then we're going to be targeting more like a 0.2 beta exposure for the equity and the credit markets, as opposed to a typical hedge fund program that's more 0.4 to 0.6 on equity markets and 0.3 to 0.5 on credit markets. So have I lost anyone, or are you with me here? So what we're trying to say is we want a program that has less sensitivity to these markets, because you already have explicit exposure to these markets. We don't want this to be doubling down on it. It does mean that it's not going to probably earn as high a return as other hedge fund programs, because we're intentionally creating a lower risk program, okay, as the dedicated hedge fund piece of your program. So that's what we're looking at here, a target of 0.2 with a maximum of 0.4. So if we find ourselves in an extreme market and you've got a 0.4 beta against the stock markets or the credit markets, we report it back to the commission and talk about what is going to be done to try and resolve that situation. So that's the risk structure here.
Now, are you applying that to, if you got one in the equity bucket, right, are you applying those same parameters to him?
No.
So different selection criteria.
This is just for the absolute return, so the hedge fund component itself, that 8% we talked about. So one of the things that staff's going to be looking at is, we have great hedge fund manager X who right now is going to have a higher beta exposure. Do we choose to put them in our equity component and keep them, or do we keep them in the absolute return component, knowing that that overall component has to have a target 0.2? So that's the decisions that they're going to be making. But it does allow them a very free choice of good hedge fund managers. You just have to ask yourself, what role do they serve in your program? Are they an equity proxy, or are they something that's here to earn a good absolute return for us? So that's the intent of this sort of framework. Without this sort of a framework, what happens? What we've seen in some plans is, in some fund of funds, is inching up of your equity exposure, an inching up of the equity long short, because over time, equity generally does outperform fixed income, credit, other asset classes. And what it ends up doing is it stops being such a good hedge. It starts being a lot more like your equity portfolio. And I think a lot of investors suffered that repercussion in 2008 when the markets went down strong. They didn't realize how much equity exposure they really had in their hedge fund program. So what we're trying to do here is to say, if you're holding somebody for high returns, that's great. Let's put them in that bucket. But if you're holding somebody for absolute return, let's be honest with what it is, and let's put into place some risk parameters that keep it within a range. Okay? Questions, concerns? Did I lose anybody? So, okay. So I was going to move on to benchmarking, if we're done with that. So we have talked about benchmarking a great deal today, and hedge funds are not an easy area to benchmark. You can't go out and invest passively in a hedge fund benchmark. There's a lot of different ways of benchmarking that exist out there. There are two primary methodologies that people tend to use, and we talk about all sorts of them here. But the two that are the most common are an absolute return benchmark or a peer-based benchmark. So the absolute return benchmarks tend to be T-bills or LIBOR, something that's a relatively stable cost of capital type of benchmark, plus some threshold that you expect the hedge fund component to earn over time. And 3 to 5% tends to be the range that we see the most commonly used out there. The other way to be looking at it is we could look at it against peers, other hedge funds, and those have their shortcomings as well. What you've been using is a peer-based benchmark, the HFRI indices. And we had recommended changing from the HFRX benchmark to the HFRI benchmark. I'll show you the difference in a minute. They're both by the same company, it's just a slightly different way of constructing peer universes. Both are valid. But we think over time, as you move to this more absolute return component, it's going to take us a couple quarters to get there, that you move more to an absolute return type of benchmark in the hedge fund component. So we could do that now if you want, but I would say let's get there and then we can look at the benchmarks and make that change. So our best thinking is, since we're moving to a lower risk type of structure in your hedge funds, let's also make sure that the benchmark is reflecting more of an absolute return component.
Can I ask, what's our return objective again for this absolute component? Because, I mean, obviously, you squeeze down the ranges, right? The hedge fund's going to take the leverage up.
Right.
Right? I mean, you know, if you got 100% of your equity, to get down to 0.2, I got to be 80 short, right? I mean, you know, so the leverage is going to go up inversely the lower I take the exposure, right? Sort of implied in that. What's the return profile we're looking for out of this sleeve again?
The return expectations for this particular, for the hedge fund component piece would be more on the order of 5 to 7% return expectations. So what stops them from levering? And Alan, it's a good point. We could put in some sort of maximum leverage constraint at the total component level too. If you want, those get a little icky to calculate, but we could figure out something we could all live with. The short answer is that if they have equity exposure or credit exposure, they're levering it up. It obviously comes through in the beta. So we want to make sure that you know, that will take care of itself. But if they're levering in other ways that we're not measuring, that's where it could hurt you. I know there is a kind of a predisposition not to take heavily levered products in the hedge fund component, but I understand your point.
Well, I mean, some of this gets to, like, I mean, even the guys who are, you know, the best at shorting, right? Shorting is a difficult activity, right? And so you're forcing the, you know, sort of leverage profile up, you know, in a way so that they can keep the, you know, the net. I think 0.2, you're starting to get pretty doggone low, right, to be candid, right? And 0.4 is, I'd say, kind of on the boundaries. I mean, you know, typical might be guys who run a decent amount, but not what I call an excessive amount, might be 175, right? So, I mean, they tend to be around between 0.3 and 0.4, but,
right.
I mean, the guys who go below that, I mean, you start to see gross numbers of 250, 300. I mean, you know, you begin to see much bigger numbers when you go below about I call it 0.35, at least in my experience, is worse.
I was just trying to think, we can go back and pull some historical, but the initial hedge fund plan that was put in place, beta in there typically was about 20.7, so very low. But my thought was going back and pulling back, I just can't remember off the top of my head what the actual net exposure was, and comparing that beta calculation versus the actual net, to see what those two coincide. And then what that leverage component was.
Yeah, I just think, I mean, again, you start going below 0.35, you begin to get a distinctly different universe of players, right, versus, 0.3, call it, maybe not as high as 0.6, but, I just wonder if we shouldn't skew that range a little more.
Upward.
Huh?
A little upward.
A little upward, right, because I do think that leverage question, right?
Your historic beta that we measured, we just did a regression of your existing hedge fund series. So we weren't looking at the underlying managers. We just took the return series and put it against the markets. And we ended up with a pretty low beta as well for your historic beta for the hedge fund overall, without regard to trying to put them into asset class buckets if they exhibit a strong beta. So I don't, with your current lineup, I don't think it poses problems. I don't think it's limiting your ability to find good managers. It definitely means that absolute return component is going to be less reliant on equity long, short managers, credit managers, but you have other places in the program where they would be. That component is more likely to be equity long, short market neutral, some fixed income arbitrage, but obviously you have to make sure that's not levered too heavily, macro, those sorts of strategies. And some of those do have some inherent leverage in them. But I think that is something that we could also look at as a secondary risk measure if it's of interest to the commission. Is that helpful? Or I don't think it's limiting is I guess where I am. But if staff felt it was limiting, then we should come back and revisit it.
I think it's worth looking at how it changes the cut of the universe, right? Because I do think, around that 0.35, you're getting distinctly different universes. People, and the previous program was designed to be low because it was part of the over.
Right.
And we're purposely taking that down. So, I'm not sure our current hedge fund lineup is indicative of what we want on a go-forward basis if we're taking the Portable Alpha program down.
Yeah, I would think that within the low beta hedge fund allocation, that's probably very similar to what we had initially. But then as we look at using long short strategies, whether it's in credit or equities, we expect those to be much more directional. And so I think that's what we're trying to do is make that separation, that distinction. But at the same time, how do you measure so you don't go over that 15% total allocation to hedge funds as well? So we want to be cognizant of that. But it sounds like that, again, I think the goal of this discussion was to put in place more goalposts, if you will, as guidelines for making these determinations and working with the commission for how we're going to categorize each manager, as opposed to a purely firm set policy, hard policy, so to speak. So that's kind of the goal of that's the goal of what we're trying to achieve here today. Is more the goalpost of this is how we would operate and go about the definitions and take a look at the benchmark. But we can come back and revisit that gross exposure versus beta question and how that influences the use of leverage as well.
Good. Any other questions on the framework? Because I want to get on to benchmarks if that's all right with everyone. So I want to summarize the different benchmarks. And let me start out with there isn't a perfect one, so they all have shortcomings. So let's just make sure. So the question becomes, which shortcomings do you care more about? So if you look at the peer benchmarks, we've got the HFRX and the HFRI. Those are both peer benchmarks, and they're both focused on, they don't include fund-to-fund, just single strategy, so direct hedge fund investment, so much more reflective of what you're doing as a program. The differences are kind of basic between the two. You've got one that's equal weighted, one that's asset weighted. You could argue for both of those, but I think the more important ones are that the HFRX, the reason a lot of people like that is they adjust the weightings to be reflective of how a well-diversified program might look. So rather than just taking all of the universe and putting it together like they do in HFRI, equal weighted, you're a hedge fund, great, you're in it. they're trying to say what's good structure. So that's great if you're structured as a typical hedge fund component. If you're a lower risk hedge fund component, it's not as good of a benchmark. The HFRI, and also the HFRX excludes funds that aren't open to new money, which I think is an important quality. I understand why they do it. You couldn't go out and invest in those funds today, but it does exclude some good funds, and I think it's important to include them. The HFRI fund-weighted composite, which is what we had suggested you change to at a minimum, as June 30th or July 1st, includes funds if they're closed to new monies, so no survivorship bias. It's very broad, but it's not necessarily reflective of how one might structure a hedge fund program. It's everyone. And it tends to have a little emphasis of equity long short. So, because that's the largest number of hedge fund strategies out there, and they equal weighted, so you can imagine that's a bigger percentage than in the HFRX. A lot of people also like to use the fund-to-fund index because fund-to-funds unto themselves are well diversified, but you have that extra layer of fees. So some people consider that maybe an easy benchmark to beat. And then you move on to the absolute return, where we're suggesting, and they're a great target for absolute return. In fact, a lot of hedge fund managers out there will use LIBOR plus 4, LIBOR plus 5, LIBOR plus 3, or T-bills. And it's, so it's a good kind of concept. We're looking to earn a strong total return over time. We're not so much worried about what the markets do. And I think it's best for lower risk programs, but one important quality is it's a very poor volatility measure. So if we're looking at the bounciness of returns, T-bills are obviously very, very stable in terms of their return, and you don't get a good volatility metric. So if you do use T-bills or LIBOR plus 3, 4, 5, our suggestion is to use other risk metrics and to make sure that we're looking at that at least once a year on your hedge fund program, because unto itself it's not going to tell you much about risk. But since we're using risk metrics in the definition of the program, I think those two fit together pretty well. And there are certain markets it's difficult to beat, and there are certain markets it's going to be easier to beat. But we think it's a good representation of a long-term return. And we're not going to really go into this, but there are hedge fund replication strategies out there that are trying to get at what hedge funds do. Honestly, they're really easy benchmarks to beat, so I would not suggest using those. I thought it was important to show performance. So we're looking at 3, 5, 10 years through March 31st of these various indices. You can see, and then I showed your components return just so you could see how it fares against some different benchmarks. Please note that we're not trying to suggest one is good or bad, but the fund-weighted composite is what we just adopted. We're suggesting that this is where you will probably want to move to over time as the program gets to its targeted levels. But here's the column I wanted to kind of tell everybody about ahead of time. The volatility. It's a horrible volatility benchmark. So we'll want to look at other ways of looking at risk. What we do with a lot of clients that use LIBOR plus 4, T-bills plus 4, is we do a once-a-year hedge fund risk analysis and just look at it on a number of different measures, give it to the decision-making entity, talk about it a little bit, staff talks about it, and then everyone's comfortable with that. Because really, volatility quarter by quarter is not the greatest way to measure a hedge fund success. I did also want to show this last column, which is the highest and lowest 12-month rolling return. So why do you care about that? What this says is, how does this benchmark look in extreme markets? And you can see another possible shortcoming here is that, this is a relatively stable benchmark. This can be a really, these can be all over the place. So this last column obviously is in 2008. So since our focus is on longer term benchmarks, not quarter by quarter, we think that the T-bills plus 4 is actually a very good benchmark to move for. We think where you are right now with this newly adopted HFRI fund weighted composite is good, but we will come back to when we think it's time to change, when we're to that point. And let me move forward for a second, I'll come right back to this. When do we think that you're going to be there? So we'll get to the definition of a hedge fund in a minute, but we'll be able to get that done shortly, early 3Q of 2013, if not earlier, classifying all your current funds into that, reviewing the roles, and then reducing the fund to less than 15%. We're looking at that taking most of the rest of this year, so that's why we don't want to change the benchmark. So let me come back to the definition. This is our suggestion. You can disagree, and if you want to do something different, we can. But we've done this for other clients, because you're not the first ones to run into this problem. What is a hedge fund? And what we did here is took some pretty, I think they're pretty broad statements that encompass a lot of different funds. We basically said, of these 8 statements, if you meet 5 of them, the majority, you are a hedge fund, whether you call yourself one or not. And so let's talk about what they are. Now, let me point out, there's a important thing down here. Private equity, real estate, some of those guys may meet some of these qualities. They're in a different bucket. Private equity, they're real estate, it's clear what they're investing in. They're not included in the hedge fund definition. So I just want to make sure everybody's on that same benchmark. So is it a private partnership? Is it structured as such? A lot of things are, whether they're hedge funds or not. That's one thing. I know Western Asset Management has private partnerships within their fixed income core portfolio, as an example. Doesn't make it a hedge fund, but it would check that box. Is there meaningful beta, 0.5 or greater, relative to equity or credit in what the manager is doing? Does the strategy allow for leverage? So is the gross exposure greater than 100%? That's a pretty low threshold for leverage. Gross exposure more than 100% means any sort of derivatives exposure, really. Can they short financial instruments? Not are they currently, but are they allowed to in their documents? Do they have performance incentives in their investment management fee structure? Do they benchmark themselves on an absolute basis? Is there a lockup longer than a year associated with them? And do they have a liquidity profile that's less frequent than monthly? So we're trying to hit cost, illiquidity, lockups, legal structures, derivative usage. So kind of all the hot button topics that tend to come up when somebody's trying to figure out if something's a hedge fund or not. So rather than saying, you know, the staff or Hewitt Aspen up or the commission think this is a hedge fund, we just want to be really clear. Let's develop these criteria. Let's see where everybody is right now. We'll report back to you. If you like these criteria, we'll come back to you with where everybody stands for the next meeting, so you know exactly where we are. We can talk about plans to move forward. Questions, critiques, issues with those criteria? Personally, I think they're pretty low bars for defining a hedge fund, so it's a more inclusive net than an exclusive net. But
Suzanne, are you suggesting that you would pick a minimum number of those 8 to define a hedge fund?
So let me explain how this would work. So think of it like a matrix, and each of the managers gets judged on all 8 of those criteria. So we would take Bridgewater Pure Alpha, and we would say, is it a private partnership? Yes. Is there meaningful beta? No. Does it allow for leverage? Yes. Can they short? Yes. Do they have a performance-based incentive? Yes. Are they benchmarking themselves on an absolute return basis? Yes. I don't know what your lockup is on that one, so I can't answer that one. And can you get out of it monthly? No, it's more liquid than that. So it clearly meets the criteria. All they have to do is any fund has to just meet 5 of those criteria to be a hedge
No, you
fund.
said 6.
It says 6.
Oh, I'm sorry, 6. Apologies, 6. Earlier draft.
It does say 5.
The books say 5. Okay.
Exactly.
Oh, yeah, I think there was a tweak at the,
Yeah,
this is the final version, my apologies.
Final, yeah, there's a draft initial.
That was our fault.
Let me, so you weren't privy to my comments. If you did that matrix, a yes answer would make something meet one of the 8 characteristics.
Yes.
Except for question 2.
Right.
You would need
Need
to
to
reverse
rephrase.
Please
engineer
reverse that,
question 2.
correct. Yes. Thank you for that. We'll make sure that's reversed.
Same thing with 8, needs to be reversed.
Oh, yes.
Oh, less frequent.
Less frequent, right. It's kind of written backwards, so, yeah, it was written so that they were all yeses. We messed up on number 2, apologies.
Suzanne, number 7.
Yes.
I'm a little confused about that. Are you saying that to qualify as a hedge fund, they have to have a lockup longer than a year?
It's one criteria that would put you in
Because
that.
there are many hedge funds that, you know, exit
Correct.
much shorter interval, like 4 away or whatever.
And we're talking initial lock here, so initial 1 year is very common.
Oh, I see. All right.
So, but yes, you're right, if somebody had a shorter lockup initially, they would technically get a
But
no
that's-
on that, even if
that's-
they were a hedge fund.
Okay, but that's only for the first year.
Yes, yes. So we're looking, and again, what we would do is take your existing managers and rate them on all of these. So clearly, many of them have passed their initial 1 year period, but we would still use that criteria just from the definitional purpose. So the intent is, if the burden of proof is that you walk and talk and smell like a hedge fund, you're a hedge fund. That's what
Have
we're
you
trying to
tested
get
this
at.
in other,
Yeah.
with other plans? and
We
all
have.
that?
We've done this for a while at State of Maryland. That seems to have worked pretty well with them because they use some more return-based asset class buckets, such as real return and credit and other places that they use hedge funds. So we wanted to make sure that it was controlled from a risk perspective.
And I would just add that if you do come across a manager that you believe is a hedge fund, but based on this criteria, somehow they, don't meet everything and they would be considered not a hedge fund, but you still believe it is a hedge fund, there's nothing says we don't classify as a hedge fund. Again, these are, in general parameters, give you good guidance as to, like you said, walks like a hedge fund, smells like a hedge fund, it's a hedge fund.
So I hope I haven't made this overly complex, but it is, the tough part about hedge funds are they're investing in a lot of the same markets and instruments that your stock and bond managers are, they're just doing it in different ways. So you do have to create some definitional and risk parameters around them to make sure they're being used, enough flexibility for staff to use them well, and enough risk controls to make sure that it doesn't get out of hand.
Suzanne, I think one of the current criticisms of hedge funds is that so many of them now are converging. So essentially, so many of them are essentially doing the same thing.
Sure.
It's becoming crowded.
Right, right. So what does that mean? So if you, first of all, that 8% threshold on on the hedge fund component, the target there, does have a range around it. If staff's not finding good hedge fund managers out there, they can intentionally underrate it. And the 15% is a maximum. You never have to go above just having the hedge fund component. We do believe there's still good managers to be found. And in fact, when we ask ourselves where are the smartest places to use active management, hedge funds are at the top of the list still. That is one of the most unfettered and freest thinking areas in order to add value out there. The traditional long-only products are really constrained and not as attractive to us from an alpha standpoint. So there are bad hedge fund managers out there, there's no question about it. You got to be good in your selection, but we still believe they earn their keep from a risk-adjusted.
That hasn't happened this year.
This year it has not. Now, so that's a good point. Hedge funds have underperformed the stock markets for a couple of years now. So some people have asked, is the model broken? You guys have done well in your hedge fund program overall. It hasn't beat the stock market, and what we're constructing here will not beat the stock market. That's very important to note. That when the stock market's up, your hedge fund component should be chugging along, earning 6-7%. That's what our kind of goal is there. We're not looking for this thing to be a high returning, highest performing component of your program, other than periods when other things aren't working. So that's what we're looking for this to do, to really truly be the hedge concept, something that's stable and moving along. Diversification is huge. So being out, not moving in the same way that your other asset classes do.
And I think you also mentioned reducing risk.
Reducing risk, right. So the diversification quality, by not moving in sync with your traditional stocks and bonds, inherently dampens that bumpy road. So as Brady was pointing out earlier, you're already in the lower risk area. This is something that will continue to support that. Now what's important is you want the whole thing to wrap up together so that it's not hurting return. Just lowering risk unto itself isn't a great goal if it kills your return. So it's making sure that both of those things are coming through in the program. The hedge fund component is not where you're getting your high generating returns. This is where you're getting diversification and stable returns. That's what we're focusing on here. Private equity, your global equity component, certain elements of your credit, that's where you're getting more of your high octane return expectations. Okay, so These are our recommendations. We already talked about this. They're the indices that we're suggesting using. So the MSCI NAFWE, which is the All Country World Index, U.S., non-U.S., includes emerging markets as well. So it's a broad-based global stock benchmark, the same one we're using, by the way, generally for your overall program. And then the Barclays credit to measure credit. And as we mentioned, that is the proposed implementation plan. Questions? Concerns? Thank you very much.
So next order of business for us today will be several manager recommendations. The first will be Golub, recommending strategy, followed by Oak Tree and Brookfield. Up will be Jared O'Connor to walk us through the Golub recommendation. Thank you, Mr. Chairman. And I will.
By the way, appropriate motions are in your package. Go ahead.
I will turn it over to Mr. Jared O'Connor to discuss Golub, the recommended strategy. This will be a recommendation for approval.
Thank you, Herschel, and thank you for the kind words at the start of the day. Before I begin, I'd just like to thank the Commission for the opportunity that I've had here. It's been a great experience. I started as an intern about 5 years ago, and I've worked my way across many areas of the organization, and I've learned a great deal. So thank you very much. We're here today recommending a $100 million commitment to Golub Capital Partners, or Golub Capital Pearls Direct Lending Program. Say that 10 times fast. And we're also recommending that this be executed through a fund of one structure. The firm is an investment management company focused on middle market direct lending strategies. They were founded in 1994 and are 100% owned by Lawrence and David Golub. Their main offices are in Chicago and New York. They have over 150 employees, and about a third of those is a dedicated investment team. Currently, the firm manages about $8 billion across middle market lending, broadly syndicated loans, and opportunistic credit strategies. The strategy that we are recommending today seeks to lend senior secured floating rate loans to middle market companies operating in the United States with the goal of holding these loans to maturity. The ideal companies that Golub would like to lend to are going to have stable operating cash flows of between $5 and $50 million a year. They'd like to see low technology and market risk and low maintenance capital expenditures required for the business model. Additionally, they prefer to invest with experienced management teams that have led the company through multiple business cycles, see strong customer relationships, and like to see competitive advantages in the products, services, or distribution channels of the firm. Additionally, they look for a demonstrated growth strategy for the firm, although they don't require that as part of their underwriting standards. The objective of the strategy is to, in this current environment, return between 6 and 7% net return. They're going to do this by preserving capital and by maintaining low credit losses, and also provide the Commission quarterly cash distributions. Additionally, they seek to diversify their portfolio by industry and across obligors, and provide loan level transparency to their investors. This allocation would fit within our private debt asset class. As of March 31st, the Commission's portfolio had about $1.9 billion invested in private debt. That represents 7% of the portfolio, which is in line with our future target of 7% that will take effect July 1st. Of that $1.9 billion, direct lending represents approximately $210 million, which is allocated across 4 different investments. 3 of those 4 investments are in the wind down period, so we're seeking to maintain exposure, if not slightly increase exposure over the short term. And this $100 million commitment represents 50% of HEK's total commitments recommended for private debt in 2013. We're attracted to middle market lending for a variety of reasons, but if you remember, as we discussed in previous meetings, there's been a secular shift in the supply and demand of capital from middle market companies. Before the crisis, there were many participants, including banks, hedge funds, and other just middle market lenders. During that time, underwriting standards degraded, and there was a structural misalignment between the liquidity provisions of hedge funds and other various investment vehicles and the underlying securities of their portfolios. Fast forward to today, there are fewer participants, although they are entering the market again, but underwriting standards have increased, and they are able to look back to the crisis as kind of a baseline to see how did they perform through the crisis. Additionally, there are regulatory constraints on bank lenders, which is further constricting the supply of capital. If you compare this to where we're at with the public market space, we're seeing record levels of issuance and broadly syndicated loans and high yield. This is mostly for refinancing and recapitalizations because the mergers and acquisition market is remaining muted, mostly because private equity and and business management are wary of acquiring any new companies at valuations that they believe to be a bit rich. Additionally, we're seeing massive fund inflows into high yield and bank loan on the retail side, and there's been a reemergence of the CLO market. All of this is creating a compression of yields and a deterioration in covenant packages in the broadly syndicated market. And we believe that although middle market is feeling some compression in the yields, we can get stronger covenant packages, and the investment horizon of the portfolio better matches the portfolio of the commission. Now, if you look at how they performed, what we analyzed was how many deals has Golub looked at, and in 2012 alone, they have managed to look over 1,500 potential opportunities, and of those 1,500 opportunities, they selected 4.7%. So they're able to use very conservative underwriting criteria to cherry pick the best investments. And have they been successful in doing that? They've generated 6.6%, 7.6% net unlevered returns in 2011 and in 2012. And then when you look at their default rate of 1.15%, which goes back to all the way to 2004 on these types of investments, it's half that of the broadly syndicated loan market. The broadly syndicated loans being represented by the S&P LSTA Leveraged Loan Index, which had a default rate of 2.38%. So that's where we're really seeing the alpha generation from this manager, is their ability to avoid defaults better than what you're going to get in the broad market. Now, how do they do this? They have a dedicated origination team. All their originators have former underwriting experience and a very focused branding strategy. So they're out in the market trying to be a business partner of choice, someone who works well with their private equity sponsors as well as portfolio management. And early on in the process, they dedicate a senior managing director to what they call triage, which is basically to give a quick yes or no to their to the potential portfolio company. And what this does is give the portfolio company a high degree of confidence that Golub will be able to go to the finish line and provide this financing. And at this stage, what they're looking for is, are the owners and executives experienced? Are they going to treat Golub as a partner? And if the company becomes distressed, is there sufficient value to protect Golub's principal that they would invest in loan? If the senior managing director is interested, he can move it on to the next stage, which will undergo some more due diligence, go to their screening committee. Based on internal dialogue and feedback, they may take it back to the potential portfolio company and conduct more due diligence. This is followed by a letter of intent, which would then basically lock in the negotiations to proceed into in-depth due diligence, which is where Golub actually goes out and gets additional third-party experts to do quality of earnings checks, legal due diligence, manager background checks. And then finally, all deals go through their commitments committee, which is comprised of the foremost senior members of the Golub investment team. And so everything gets approved at that level. If we look at the terms of the structure, we can see that it is a 1% management fee. Well, these are the standard terms, excuse me. Standard terms are 1% management fee, a 4% hurdle rate, 10% carried interest, and a 3-year rolling clawback. There's a 1-year lockup and an evergreen investment period with 90-day notice required to terminate the investment period. With that in mind, I will say that the staff has been in negotiations with Golub, and we believe we're very confident we will have terms better than this if we move forward with approving and going towards closing. Hewitt has reviewed this investment. They give it a pass rating, a buy rating and a pass rating on the operational due diligence. And with that, I'll just open it up for questions.
Yeah, one thing you might want to mention is on the loss ratio, actually the actual loss ratio.
Yeah, the average loss.
I should say default or loss.
So the default ratio, or the default rate, average default rate since 2004 is 1.15%, and then the average loss rate is 0.63%.
Right, I think that one of the important considerations here is the recovery rate on default, about what, 70%, something like that?
I would say about a little under half.
Okay.
About 50%.
So the risk element here is quite small.
They have done an exceptional job of picking quality firms and avoiding defaults. Going through, they're 50%. I think that's in line actually with what the broadly syndicated market recovery rates are on their loans, actually, for historical rates. But when you're defaulting less and you're performing in line with recovery rates of the market, then you're adding value.
in the motion that was given to us, is the recommendation the memo or is the paragraph?
So I believe the motion language was provided by the legal team, which is what we would ask the commission to put into the minutes.
So is
The
that-
recommendation is just us trying to simplify it at a high level with the investment staff.
Commissioner Loftus, it should be at the bottom of page 1 of the motions packet.
Well, when the motion refers to the recommendation, what is the recommendation?
Well, I will just say that what we are recommending is a $100 million commitment to this program implemented through a fund of one structure.
So then it is just a paragraph. It's not any of this other, it's not anything really what's in the paragraph. $100 million to go and structure determined way.
Correct.
Paragraph Roman numeral 4.
And who was the commissioner on this?
Mr. Giove participated in due diligence.
You recommend it? Yes.
I'm sorry.
You recommend it?
Oh, yes, well, I have a high degree of confidence in Golub. I was very impressed with the, well, obviously, for the record, and within that industry, they perform very well relative to others. They're very cognizant of risk. I think they're very selective in what they do and the returns that they make.
Can we put you down to making the motion?
Yes, I will make that one.
Who wants to second? I'll second. Any more discussion?
Well, I know we have like new disclosure things. I didn't know we were talking with Golub, but, you know, they have a public BDC, and one of the board members is from Spartanburg, Billy Webster, who I know. And so I've talked with them before about Golub Capital. David Gollub's they were White House Fellows together. Billy's a Washington League grad, so I'm gonna, you know, not knowing that it was gonna come up, it's probably best that I abstain.
We get back to some of these other questions. So, and as you kind of just recommended, that the terms are very good. We're not voting on these terms. All we're voting on is one company, one amount of money, and not necessarily a structure. I don't know when the final, the prohibition to final delegation of the investment authority takes place. I don't know what what that means. Is a company, is it just that? Is it terms? Is it lockups and gates? I mean, where has work been done on these things? This all comes back to a lot of problems we had before. This effectively, as long as we give these people $100 million, we can have no complaints.
Mr. Loftus, just in regards to the terms that are listed in the memo that you have, what we're saying is those are their standard terms that they provide to everyone. And when we go through and finalize the legal contracts, the terms will be no worse than that. And we're very confident they're actually going to be better than that.
And I appreciate it, Jerry. You did a great job. Is this your first time
Way to go out.
But I know that, but we didn't vote on this.
Well, we're getting ready to vote.
No, we're voting, and I asked this question twice, and everybody's agreeing. The recommendation of the commission is approve $100 million to go.
To adopt the recommendation of internal investment command, the CIO authorize a commitment not to exceed $100 million to go so-and-so to be implemented through a fund of one structure, either through a limited partnership or a limited liability company structure, to be determined at the discretion of the CIO. Authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented proof of legal sufficiency by RSS's legal counsel. 2, upon expiration of the review period as adopted by the commission on July 19, 2012, or as the review period may be amended by the commission, and authorize the chairman and or the CIO or their designees to thereafter authorize the custodian of the funds to transfer such funds as are necessary to meet the retirement system trust fund's obligations with regard to the investment period. That motion would adopt the recommendations as presented, beginning page red 319 by the committee, by the internal investment.
Well,
Authorize the CIO to further negotiations consistent with that. Authorize the chairman to sign the various documents once they've been appropriately vetted. So there's nothing left that the commission would have to do after this motion.
The first question I asked was, what is the recommendation? Is it a paragraph in here for the whole memo? And I was just told it was the paragraph. And then you say it's not the paragraph.
But
It's the whole memo.
I have read the
I'm happy it's the
paragraph.
whole memo. I think it's a good investment. But is it the paragraph or is it the whole memo?
Key terms as presented in the memo aren't, right?
Nothing's in the paragraph, it's $100 million.
Well, I interpret the recommendation of the internal investment committee to be the recommendation as set forth in the memo. If that's not the recommendation, somebody needs to say so. Always has been.
Well, I just asked, and on the record have been told that it wasn't. So I'd love to clear this up without any acrimony. If it's the whole investment, we'll get right on top of it right now. Give you the whole memo. But if it's not, let's just be clear.
It's pretty, all he's asking is that that we change, I'll make a motion that we amend the sentence, authorize the amendment not to exceed $100 million at a fee level of,
1% management fee.
1% management fee, performance fees not to exceed, just add
To
all
incorporate the
details.
terms of the memo.
Yeah, to incorporate the terms of the memo, that'd be fine.
How about that? How about that?
Yeah, do that.
In the memo or?
Does it not already say that? So what should
Can
we
we
say?
say, would this address?
Adopt the written recommendation of the internal investment committee as presented to the commission.
Well, it's still, the recommendation is still just one little key paragraph in the memo. Key memo. Just incorporate the memo.
Right.
And the key terms in the memo, or however you want to say it, or better, or.
I think that's
more
important, is
favorable.
that we're still
In
negotiating
terms of
terms and they
what
should
as
be
addressed in the memo, or more favorable, let's negotiate.
But, that's where the legal suspicion comes in, because I don't think anybody would anticipate this whole thing being exactly like this. You might get a little more on something, or less on something. And that would be where you come back and say, hey, guys, we couldn't get one, we got 1.2, guess what? We had great growth in our work and stuff. So we think it's legally sufficient. This is all, headed the same way. Because what I'd like to do is, once we vote on this, we know we get roughly this, if something doesn't happen correctly, or there's a substantial deviation, it comes back to us in writing. Otherwise.
That's been consistent with the prior practice. So I hear that we amended to say adopt the recommendation of the internal investment committee as presented in its memo dated May 20, what's that date?
May 23rd?
May 23rd, 2013.
Great.
And presented to the commission.
And what was that before?
To adopt the recommendation of the internal investment committee and the CIO as presented in their investment memo dated May 26, 2013.
That still doesn't incorporate terms, it still goes back to the paragraph of recommendation.
It's the entire
As
document.
presented in the memo.
You're now incorporating the entire document.
Yeah, as presented in the memo.
That's fine.
So that would incorporate
The whole document.
The entire document.
the recommendation of the investment committee? That,
The entire document.
Don't understand why we couldn't say that.
Just want to focus on the key terms of the document. Mr. Loftus even mentioned that I don't think we want an investment to get held up if, in paragraph 50 on page 20, there's something changes immaterial. But I think the whole discussion is around the terms, right? I don't think we want to loop in the whole summary memo.
It's this chart on the first page. You want to make sure that it's more than just a
That's
$100
right.
commitment.
Roughly that's fair. The person who writes things, hey.
I just think it needs to say that. It just needs to say that.
It just needs to say that. So far, we keep referring back to the recommendation.
I mean, this paragraph below this chart, I think it says recommend approve up to $100 million. Along the lines of the above terms, I mean, along the lines, I mean, that's what
To incorporate the summary
this is our
chart.
target.
Right.
further discussion?
That did we settle on the final language as saying incorporate the summary chart? Because I would be very like taking a hold, you know, what's back here, getting some pretty good sales done, you know, and cover that. To incorporate the summary, Mr. Fine, we can have some.
I'm looking to the chairman. What is your pleasure, Mr. Chairman? I mean,
Someone's going to reset the motion. I thought we'd adopted it about 10 times. But adopt the recommendation of the Internal Investment Committee and the CIO as summarized in its chart on page 1 of the Investment Commission memo dated May, whatever, 2013. Semicolon, and then continue on. Would that do it?
You mentioned summary chart.
Yes, summary chart, yes. If we just add summary chart someplace that recommendation, I appreciate your indulgence.
Nancy, you want to read that back?
let's try it. Adopt the recommendation of the Internal Investment Committee and the CIO. The recommendations, sorry, let's make that plural. Adopt the recommendations of the Internal Investment Committee and the CIO as set forth in the summary chart on page 319 of the investment memo dated May 23, 2013.
Semicolon, and then continue on as.
Yeah, correct.
I will, as the motion,
As amended.
I will amend that.
Did I hear a second?
Well, I'm abstaining, so I'll let someone else do
Two
it.
people.
Okay. I heard of the noise, but I wasn't sure where it came from. Are any further discussion?
Who was the second?
Travis.
So we have 2 seconds.
It initially had been,
I thought right now did. Any further discussion? All in favor, signify by saying aye. Aye.
Thank you very much.
With that said, I've been notified that there is some lunch available, so take my Parmesan and.
Who's going to present on those? Who's going to present on those?
David Locke will present on the next recommendation.
But I don't want to stand between you and a plant Parmesan, so it'll take another minute.
Well, I got you, I want to say that the memos on these 3 investments from HUK were just outstanding. I thought, damn, that was real good.
Expect nothing less.
Great.
Just in reference to, 2 weeks ago, I think it was, Barron's ran an article on middle market lending, and they mentioned Golub as one of the outstanding companies in the sector.
So the memo begins on the red page 94.
They've been ready to hear Frank.
Okay. Thank you.
Ms. Fontaine, you and the legal team might be, while he's presenting, you might be thinking of the appropriate way to amend potential motions 2, 3, and 4.
Yes,
So
sir.
that we don't have to.
Yes,
spend
sir.
that much time on it.
Great. First of all, I'd like to thank Eric Corelli and James Wingo for their hard work on Oak Tree Real Estate Fund 6. As you know, Eric, we were able to hire Eric from Arizona's plan last year, and today he is packing boxes and moving his family from Arizona to South Carolina, so we send our best to him and his family. For Oak Tree Fund 6, this is a continuation of the same strategy that we had that was used for Fund 5. As the commission may recall, we approved an investment for Fund 5 back in late 2011 for $75 million. Currently, Fund 5 is over 85% drawn and has grown to approximately 1.1 times on invested capital. The rationale for Fund 6, again, is very similar to Fund 5. Oak Tree is a well-established organization with $78 billion of assets under management. that focuses on buying distressed and stressed assets where value can be realized through going through some type of restructuring process. The track record has been proven to be consistent with low double-digit IRRs and a 1.4 to 1.7 return on investment. The real estate funds utilize a lower level of risk compared to other opportunistic funds. Track record is a result of conservative underwriting, reduced leverage, and focus on downside risk in each investment. There's broad diversification across each fund. They focus on commercial real estate, corporate real estate, CMBS, residential real estate, bank portfolios, and non-U.S. related real estate. They have a robust team of 35 investment professionals with 7 managing directors in the U.S. Oaktree has a broad operations group with over 100 people supporting the accounting, auditing, compliance, and other areas, located in 4 offices in Los Angeles, New York, London, and Hong Kong, and they're registered with the SEC and the FSA. There are 2 items of interest that should be noted. 8 years ago, the real estate fund experienced a significant amount of turnover with their then manager, Russ Bernard. Russ had a disagreement with the Oaktree founders in regards to market valuations. The founders were very conservative and felt that the correction was coming. Russ was replaced with a gentleman by the name of John Brady. John came from Colony Capital, which is another well-established real estate organization, and since that time the team has been fairly stable with minimal turnover. There's also been a low level of distributions from the funds managed by John Brady. John took over in 2007, and over the last 5 years or so, the real estate market's been through a very tough time. So that accounts for the low level of distributions that we've been seeing coming out of the market and out of the prior funds. Staff and believes that we're going to see more distributions coming over the next 24 to 30 months. Some other notable items. Currently, their market conditions are very supportive for Oaktree strategies. There's a large amount of stress and distressed assets in the market today, and we believe that that's going to continue throughout the investment period. Oaktree has a proven process to source, underwrite, and select investments and continue to focus on the downside risk. They have a broad base of investors, which includes large public pension funds, endowments, sovereign wealth funds, foundations, and family offices. The terms are in line with market expectations. The general partner is going to put in approximately 2.5% of committed capital. The fund size is going to be between $1.5 and $2 billion. There's a 1.5% management fee and a 20% carry. Investors, as usual in these types of funds, will get their money back first, plus an 8% preferred before the general partner will be allowed to take any money out. There will be a 4-year investment period with a 10-year term plus extensions, and the final close will be in September of 2013, so coming up in a few months. We expect to get an advisory board seat. Looking at the operations side of the business, the custodian is Boney Mellon, auditor is Bryce Waterhouse, legal is Deborah Braun Plimpton, and they have disaster recovery locations in Los Angeles, Arizona, Connecticut, and London, and they've partnered with SunGard and Citrix, which are experts in this area. We've received an endorsement from Commissioner Giobbe, and Hewitt has signed off on it as well. Internal audit has signed off on the process, and it was approved by the Internal Investment Committee and the CIO. So at this point, I'll open it up for questions and go from there.
Yeah, I mean, I guess the only questions I had, right, I mean, the organization recently went public, right? The funds they're raising are coming in faster succession and much bigger size than historically, right? Any indication of, sort of changing incentives, right? I mean, as a public company, as AUM versus, that risk return trade-off. I mean, our last experience with manager that had just gone public was Bazina, right? Subsequent performance was poor, right? Because typically, obviously you get public because you have a long backlog of solid performance. Any sort of reaction on that?
Much of the ownership is still retained within Oaktree and with the Oaktree team. 65%. So, the majority is still held by the partners, which I think helps align the interest with the investors. So that's kind of the first item that I look at. I think in regards to the concern about the funds coming back sooner, for this particular strategy, the real estate strategy, they are finding a robust amount of opportunities out there, especially coming from residential and from bank loan portfolios. And I think that's just, a testament to what the market conditions are like today. And we had invested in a European fund right around the same time, and the capital that's been going out for that has been going out at a much slower pace. They've been much more selective, they've been much more, I don't want to say they've been much more diligent, because I think this group's been diligent as well, but I think they're just being much more particular with where that money is going out. We're expecting that fund to come back in fundraising maybe next year or the year after. So I really think it depends on which part of the asset class you're in. We'll probably expect to see real estate slow down, after this fundraising cycle, or it's going to again be more selective on one of the 6 opportunities that I listed. So, but to your point, whenever you have a company like this that goes public, you always kind of worry about to make sure that the interests are properly aligned.
Yeah, I mean, this fund is much more significant in size than any of the others listed, and it's right on the back of a fund that was much more significant in size than any other that they'd ever listed, and, I mean, they're back-to-back years.
Yeah,
They're getting into that mode of raising a fund all the time.
Yeah, and I think that's more of a kind of a testament to what we're seeing in the market, and it's not going to be something that you're going to see over the long term. I think probably the next one you'll see over the next 3 years, and then it'll stretch out thereafter.
It's not unique to Oaktree. We've been seeing a number of managers have that same situation because of the market opportunities in real estate. But we worry about product proliferation at Oaktree too, and spend a lot of time just making sure that they're digesting what they already have.
Any other questions? Oh, yeah, that's, I'll defer to legal on that.
And who's the commissioner on this?
Mr. Giobbe as well. Mr. Giobbe was assigned to real estate, so this one and the one that will be following will be Ed, and then for direct lending, it'll be either Ed or Travis, so we, kind of work.
Didn't we used to always put the commissioner sign on the investment?
We did. I think we did, yes. We can continue that again.
And one last thing, I noticed this is the investment team and not the investment. Is that the same thing?
I'm sorry. Let me take a look at something. Okay, so it's coming from, if you look, it's coming from Herschel and the Internal Investment Committee, but if you look in the footnote in the back here, yes, that's so I'll let you discover that.
Is it likely that you'll see a lot of that from specialized like real estate?
I think what you're going to see, that's going to be kind of the new format going forward, because when you think of kind of the rank, kind of the order in which we're doing things, you have the team rolling up into the Internal Investment Committee, and then in Herschel, and then you have the Internal Investment Committee and Herschel rolling up into the Investment Commission. So it's going to be coming from Herschel and the Investment Committee, but the folks that do the due diligence and have done the work on it will be on the back page. So there's a level of accountability there back down to the staff level.
Ed, you've moved. Is there a second? I hear a second. Any further discussion? Questions? Please. Call for the vote. Robert, why don't you read how the first sentence of this written Roman numeral 2 recommendation?
Yes, sir. Adopt the recommendations, plural, of the Internal Investment Committee and the CIO set forth in the summary chart on page 294 of their memo dated May 23rd, 2013, and semicolon, then just revert to the review.
All in favor of the motion as stated, signify by saying aye. Aye. All opposed, like sign. One opposed. Pass out.
Oh, there's one opposed, I'm sorry.
Yes.
Oh, okay, thank you.
Can I ask a question, Chris? Mr. You voted no on it?
Yes.
And
Signed to it quietly. It's the whole legal sufficiency thing. And all this stuff goes back.
All right, well, I guess I want to be clear. Do you have any objections to the investment per se?
No, I mean, these are good companies. We have good. The problem we have is we vote for something, and another investor here would have that problem. So that's why legal sufficiency changed its motion, the rule in the motion. It makes a lot of difference because when things go, if something would go wrong in years to come, they say, well, no, this is what we do. So I'm just trying to make it clear and simple so that when somebody walks in the room, they say, man, they voted on it. And move right forward. So, not trying to make a big point. I mean, we're going to talk about legal sufficiency later on.
All right, so your point is legal sufficiency?
Yes, sir.
All right, who's going to present on Brookfield?
Yes, we're going to present Brookfield.
Page 240.
Red page 43.
So we're recommending an investment of $75 million in Brookfield Strategic Real Estate Partners. This fund will be a commingled vehicle focused on global opportunistic real estate investments. We do have an existing relationship with Brookfield through their real estate mezzanine fund, which is a debt-focused strategy approved by this commission in September of 2011. Brookfield was founded in 1899 as an infrastructure company, and since then has evolved into a global, vertically integrated owner and operator of real assets. The firm has $175 billion in assets under management, 23,000 employees, and 500 investment professionals spread across North America, Europe, Brazil, and Australia. The firm's been making opportunistic real estate investments since 1987. The key reasons why we believe the investment is attractive are primarily Brookfield has, over the past 30 years, built large-scale operating platforms across all 4 major real estate sectors. We believe these platforms will provide both strong deal flow and operating expertise to the fund. Additionally, this fund will be Brookfield's sole vehicle for executing opportunistic real estate transactions across all of its operating platforms. Third, we believe the fund structure provides for good alignment with the limited partners. First of all, because Brookfield is investing $1 billion alongside limited partners out of a total fund size of $3.5 billion. Brookfield's also demonstrated a strong track record in opportunistic real estate dating back to 1987 again. The fund will be led by an experienced, stable management team that has a long tenure at Brookfield. And lastly, we believe there's a compelling market environment for Brookfield to execute the fund's strategy, given ongoing repercussions from the 2008 financial crisis. We did identify several considerations during our due diligence, however, which I'll briefly review. One, Brookfield employees themselves are not making direct investments in the fund. We feel this is largely mitigated by the fact that Brookfield senior managing partners do own 20% of the firm, which itself will be the largest investor in the fund. Also, the senior investment staff who will work on the fund will have the largest part of their compensation tied directly to the fund's performance. Also, the firm is the subject of a pending lawsuit. The investment team here, along with the consultant, Hewitt Ennis Knapp, have looked into the matter at length and concluded that the litigation is not material to the firm. And finally, Brookfield doesn't have a long track record of investing in real estate through the opportunistic, through the commingled fund structure. We do feel this is mitigated by the fact that Brookfield does in fact have a long track record of investing in real estate, albeit in balance sheet deals and not through the commingled fund structure. In addition, they do have significant experience investing through the commingled fund structure in other strategies and in real estate beginning in 2006. The fund strategy will be to invest 70% capital in large-scale corporate real estate transactions and the remaining 30% in mid-cap individual asset acquisitions. The fund's already invested roughly $800 million, or 23% of the total, giving us some insight into the fund's portfolio construction. The fund will target net returns of 16% and a net multiple of 2 times invested equity. We have reviewed the fund's back office functions as well. The operational due diligence has been performed alongside of Hewitt, the consultant, and neither of our due diligence processes have revealed any material weaknesses in the fund's back office. We've also reviewed the terms and conditions. Overall, we think the terms and conditions for the fund are roughly market terms, with the exception of the size of the GP commitment, which is seen as a key positive. There's a 1.5% management fee on committed capital during the commitment period and 1.5% fee on invested capital thereafter. There is a clawback provision which is guaranteed by Brookfield. There is a 9% preferred return, after which the GP will receive 20% carried interest. The investment period is 4 years, the fund term is 10 years, and the final close is scheduled for July 31st. In summary, we believe this fund is a high conviction investment for our team. The consultant has conducted independent due diligence from both an investment and operational perspective, and Commissioner Giove has also participated in the due diligence here. Additionally, the RSIC internal audit department has signed off that we followed all of our internal processes and guidance. So with that, I'll turn it over to everyone else for questions, or Commissioner Giove for additional comments.
What's kind of the distribution policy on a fund like this? Are they?
So the waterfall's 9%, so we'll receive back our capital plus management fees plus a 9% preferred return, and then.
Right, but is all that on the back end? Do they intend to distribute over the life? I mean, it's a 10-year lock fund. I mean, are there any interim cash flows, or is this a pure capital appreciation type play, or?
No, there are some of the mitigating factors are the fact that the long-term incentive for the funds, for the professionals working on the fund, will be subject to a 5-year lockup. So it is deal by deal carried, but at the cumulative level, at the calculations done at that, at any point where there's a deal done, or there's a distribution.
So they will distribute within that 10-year period?
Yes.
So as they realize,
Right.
some back.
Right, exactly. So at every realization, there's a distribution back to investors and a calculation for all capital that we've contributed up to that point. And then there's a 9% preferred return on that, after which they'll begin participating in carry.
And how's the clawback work? Like if on the investments that get held, below that, it's on a deal by deal?
Well, I understand it's escrow, and then there's the cumulative calculation of it, deal by deal, so that there's a netting effect. So that if we do have some deals that will pull that carry back in, or reduce that carry, then it will be reduced. So make
Right,
sure we miss that.
Yeah, that's correct, and the critical thing, I think, is that clawback is guaranteed by Brookfield with corporate.
And I just want to clarify one thing. I did a completeness review for the new procedural checklist. I know there's a little bit, it gets explained differently, and we'll clarify that in the next procedure, but it was not an audit of the whole process. That will be done at a subsequent time.
So this too would be an investment, is a recommendation to the commission.
Ed has moved it.
I'll make that motion.
Friendly amendment, okay?
Pardon?
Is that a little friendly amendment, okay, for the wording?
What terms in that chart to be included?
Yeah, do I hear a second? Anybody?
I'll second.
And then, as I understand it, Robert, read us how the first sentence
Yes,
will.
sir.
now,
Adopt the
first
recommendations.
will-
Yeah. Adopt the recommendations of the Internal Investment Committee and the CIO as set forth in the summary chart on page 243. Their memo dated May 23rd, 2013. And then revert to the original.
As I understand, that's, as amended, that was the motion made and seconded. So now that we have the discussion. More questions, discussion? Hearing none, proceed to vote. All in favor of the, that signify by saying aye. Aye. All opposed, like sign. One opposed. Ayes have it. Thanks. Okay. Do you have anything else to take up, Mr. Chief Investment?
Mr. Chairman, that concludes the investment staff's recommendations and comments, unless there are any other questions. Mr. Alden is next.
Chair recognizes Chief Operating Officer.
Thanks, Mr. Chairman. Everybody was here at the last meeting knows I gave my assessment then, and near the end, I said that there was several long-standing issues that were affecting the commission and other parties here, and one of them I chose to spend some focused time on, which I did right after the meeting, and that was the issue of an outstanding NDA and exchanging confidentiality information with, say, fiduciaries and their staffs. Shortly after the meeting, I sat down with our legal staff and had some discussion with a member of the Budget Control Board staff that was helping us in trying to work that out, primarily with the Treasurer's Office. And my feeling is that when you have issues like that that are difficult and complicated, and people are kind of digging in their heels, and that means that everybody should try to compromise. And I came through, and I think Robert and our staff will testify that I wanted us to do a strong compromise on some of the primary issues that were in this document, how do we exchange this information. And that resulted in a draft, I guess it was in the materials. Read page 341, which is a draft right now, I'll stress that. And everybody can read this, but let me tell you what my view of the intention of this document is. If it doesn't say that, we'll work hard to try to get it across. But to me, this should be a document that's signed only one time by what we call a named principal here, a primary party that wants to designate staff to get information that the designated party, the named principal is entitled to. So this will be signed once. It's intended to cover all prior investments by the Commission and any proposed future approved investments by the Commission. Signed once, and all designated staff would get hard copies of the information. To me, it's as simple as that. It's requiring the designated parties to uphold the same principles of confidentiality as the named principal, and would be responsible for any breach provisions the named principal. And again, if this draft doesn't say that, anybody that we need to talk to negotiate this, that's the intention of this, happily work out for it. There's an exhibit here that it's an extensive list of documents that would be provided under this agreement. This list clearly is not every piece of paper that the Commission staff would touch related to any of these investments. Of course it isn't. It's a draft list. When I looked at it, it seemed to be more than sufficient that if anybody needs to get comfortable with issues of custody, or, as we've talked about today, that's still, to me, somewhat ill-defined legal sufficiency. If somebody wants to determine if a proposed investment was approved, this is what actually was agreed to in final contracts. I mean, to me, this list of documents would allow somebody that's in a fiduciary, top-level position here that has to make that determination that these documents should get that again as draft. So that was my intent here. We sent this to, and we're talking about the Treasurer's Office, so we're trying, really trying to work this out with. Sent it to them late last Wednesday night. Have not heard back yet. I'm very anxious to sit down and talk with the Treasurer and with his staff, and I'm happy to get anybody else in the room that we need to, our legal staff, other commissioners. I really want to solve this. Haven't heard back. I understand the Treasurer's Office has been busy on some other important issues over the last week. So with that being said, there were a couple motions here in this package that we were going to propose today, and my feeling is that we should just table those until we have a chance to sit down and talk with the Treasurer's staff to get feedback and and work reasonably to compromise to try to work this out. And that's my report.
Anything else?
Oh, I'm sorry. There is one more piece of this. Sorry about that. In conjunction with this ADA, I apologize. My understanding is we have this 30-day review period, and that's the period between the final contracts being ready to be signed and the chairman actually signing them. And my understanding is that 30-day period was instituted basically as an accommodation, for the Treasurer's Office, because there were issues related to his staff not being able to see documents and get hard copies themselves. And so that's why it was there. My feeling, and this was one of the motions we were going to talk about today, was assuming we can get an acceptable NDA, we shouldn't need a 30-day period for a review by designated staff members to help the treasurer or other fiduciaries that have to get their staff. To review these documents and get to a conclusion, because in our business, I've certainly come to understand time is of the essence for us to finish up our business. For example, I understand the Brookfield investment, we actually had to ask them for a 30-day extension to get into this final closing because of this 30-day review period. If it played out, we wouldn't be able, we'd be able to go forward. So the recommendation would be, if we get an NDA that's acceptable, we also ask for a reduction in the 30-day period to 10 business days, which is probably at least 12 calendar days to get through a review, so that the chairman then can get comfort to sign it.
Would you like to suggest that we table that also until we?
Both of those motions, I just neglected to mention.
There you go.
That.
Everyone here
They're
knows
all
that my
tabled.
attention span is about that of a 3-year-old.
The two would be in tandem,
Right.
table in tandem. Remarkable. I'm sorry.
One thing I will, again, I think I discussed this with you the other day. I guess I'm a little unclear as to whether it's a 30-day period or a 10-day period. Objections or concerns that are raised during that period. What is the criteria for any further action, or what action would be taken in the event of a commissioner or anybody raising an objection? I want to be a little more clear as to exactly what the purpose of the 10-day review period is. Once an investment has been voted. Now, I understand that if there were any material changes, that obviously wouldn't change the entire picture. But is there a little more clarity that can be introduced into that whole discussion?
Well, I guess I'll defer to someone that's been here longer.
I think it's important.
My only exposure was before vote, where during that review period, as it was extended by 2 weeks, the treasurer raised a couple questions, and on the last day of the extension period, I made sure that the staff responded. And in that email, they instructed, the chairman could go ahead and sign the contract. And that's how it worked with Warwick.
I've been the only chairman since we adopted that period. I haven't. The way I have intended to act is if I ever got a substantive objection to the document, I would try to deal with it with staff, get them to deal with it by negotiating with other people. If we were unable to resolve the substantive objection in some reasonable way, and it involves either a very material matter or material change from understanding, or if it rose to the level where exercising my fiduciary obligation, I felt that it required action by the full commission, or action by the commission. I guess my intended step would be to communicate with other commissioners, let them know what the substantive objection is, receive comments, try and deal with it. If I couldn't deal with it, then call a special commission meeting. None of that has ever happened, but that's the way I intended to act. And I've never tried to reduce that to writing because the circumstances are so infinite on the nature of somebody's objection. If they object to a typographical error, and I would say, well, thank you, great, I'll get them to change it. If they object to a paragraph being omitted, I'd say, great, we'll change that. If they objected because they didn't like the way something was written, I would exercise my judgment on whether I thought it could be clarified or written more clearly and tend to it. And it's just a whole array of things that you can't anticipate what might happen in the future. And every chairman that we've had has acted consistently with that, so far as I know. The wanted to make sure the documents were consistent with what the commission wanted, and if there was anything about it that made a chairman feel uncomfortable signing it the way it was presented, take it back to the commission and get a decision.
Well, the commission never saw the contracts, that the little contract agreements. And generally speaking, talking to 2 or 3 chairmen that I met, they oftentimes sign just signature pages. I'm just gonna be quiet on this, but you were kind enough to say.
Well, I can't speak for other chairmen. Before they had the 30-day signature run, I only know what I did. But I can't speak for other chairmen. I believe that the other chairmen exercise the fiduciary judgment and decide what they want to do. We instituted the 30-day thing at the very first meeting at which I was the chairman. I've been subject to it. Every single contract that's been signed since July of last year. And that's the way I operated, and would continue to operate in the future. And I think that's the way future chairmen should operate. Somewhere along those lines, they exercise their own judgment about what's consistent with their fiduciary obligation.
I didn't know of the 30-day rule, no knowledge of it coming, and committee that found it. I like the idea. I personally think we should get rid of it now, because if there's no written regulations, then it's a facade. If one person has the judgment, then it looks to the outside like it's meaningful, but it's not. Of course, to go back to the old saw here, the point of the 30 days, and this kind of that conversation about taking some liberties, because Mr. Powers was, what does the final agreement say? And in the past, like I said, a couple of the chairmen I talked to, most of them, many of them, all of them said key different points. They signed just the signature page, and I understand that. But that was the point of a written document that was sufficient, which was very easy to do.
In fairness, it's only the signature pages that call for a signature, so why would anybody sign non-signature pages?
Well, you would read the others.
Well, I assume that each chairman read what he felt he needed to read in order to intelligently sign, affix his signature. That's what I do.
But the signed agreements of totaling billions of dollars never came back to the group from whence they originated. We had no document that said that they were the same, and we had no assurance that the chairman had read the document because he had taken a verbal pledge of sufficiency. So we're right for this, and we're not.
The commission addressed all this in a meeting where you were present last July, and they resolved it with imposing the 30 days, that everybody look at it for 30 days and then deal with it. And so far, that's functioned reasonably well. There's been times when we needed to waive the 30 days requirement, and we did shorten it. But if we can get it, I think that's a reasonable recommendation that Darren makes. Let those 2 things go in tandem. We'll get the disclosure agreement resolved. Let's shorten the review.
I also want to comment about what the chairman said here about what would happen if something significant came up. I think staff has already said in the Warburg transmittal that we're going to raise our hand and let somebody know if there's significant changes to these, let's say, summary charge terms. There's no reason why we wouldn't. I mean, we want the commissioners, I personally want the commissioners, Herschel does, we want everybody to feel comfortable. And that's why we're trying to do our job. But when the commissioners themselves are reviewing these documents during the 30 or 10 business day period, and somebody sees something that says, holy smokes, did anybody realize this? Then I think everybody would want to know that, raise our hand, and let's make sure we do the right thing. It's a reasonable man's principle to do that. So if, the treasurer finds something, or Alan finds something that nobody else saw, I think, you don't need a piece of paper with a procedure. I just say, look, this isn't what we thought was going to happen. We ought to be able to sit down and talk about it and make sure 2 wrongs don't make a right. I mean, I would be leading the charge, and I'm sure Herschel would be to make sure that happens. So I don't care what we had for 30 days. If somebody sees something, raise your hand and let's talk about it. If it's significant, like Reverend said, if it's significant enough, it should be addressed appropriately.
So the only comfort a commissioner would have is if he read the entire document. You just said, you're not going to be provided with a sufficiency letter, and he's counting to read the document. Well, fine, I'll read it. when I get a print, I can't do it either, ours.
Well, that's,
So, and you said it was easy, and you said it was, I think something like everybody would vote for me. I think that's just great. I just can't imagine why I can't get like one more piece of paper. So we can all look at that and say, wow, this is great. I can save myself $5.
Well, again, I find a lot of this very confusing. The suggestion is that every commissioner should read every single contract, whether it be 50 pages or 150 pages, to determine whether, in fact, they are properly drafted.
I think it's ridiculous. That was Mr. Oliver. That was Mr. Oliver's decision. I never
no,
said
I'm
that.
saying if somebody sees something when they review the documents,
If I can't rely on our legal staff to tell me that that contract isn't properly drawn, what validity would it be for me to contest a legal document without, I'm not a lawyer, I don't have legal training.
Wouldn't you think?
No, but can I maybe give this some context and just kind of, right, there are a lot of investments where documents exist prior to us taking a vote, right? Very standard stuff, you know, think about the mutual fund, IMA agreements, pretty, not completely standard, but for the most part, pretty standard, right? Versus one like Golub, right, we just approved that we're gonna create a new structure of an entity of one, right? So, like when I was chairman, we came up with the conflicts document, right? And not because, but, obviously managers disclose things in those documents that aren't part of the, what I call key terms, right? That I thought needed a little bit more definition, right? And so in my mind, the 30 days was, let's actually get the final documents, right, out there, right? There's some period of time unless that Golub document's already drafted, right? And I don't think it's gonna be drafted in the next 10 days, probably.
No.
Right? I mean, so I was kind of under the impression 28 days was for us to get a, real document and give people time to look at it if they wanted to. Not everybody's gonna choose to, but. For investments that don't have documents yet, right?
Right, so once you get as close to that final document as possible, that's supposed to be for the 30 days.
For new investment.
Let me close Laura's question. Again, I don't think that anybody at this table has a great desire to read. We have all of us have a desire to trust the staff. But I don't know of any bank, service company, I don't know of any insurance company that has large sums of money changing without some certification for those who do it. I know a lot of commission, the contracts actually come back to them, those customers. I know that in certain states, they have an attorney who comes back and reviews it with key members of the staff, and then things go by. The simplest page, it's just beyond me that it's, everybody's leap at the opportunity to say, these are the documents we had, if there's a change, I don't know about the legal staff, and it's just great, because I'm not lying. So if I'm wrong, if we were 1.5 and 20, but somehow we end up 1.75 and 20, we just didn't have a choice. It's either walk or not. It's written right here. They put that away, liability's gone, we've got a record for it.
Well, again, I want to be perfectly, so your suggestion is they just have a one-page summary that says, everything that we voted on or was authorized is incorporated into this.
Yes, sir. It's the simplest document on the planet.
Every time I get a document signed, I have one of those. A real simple summary I send it to them. But
could you provide that to us?
I think the commission gets a copy of that email at the same time I can.
And I've talked with Jerry and Robert about establishing something, which I think are along the lines of what you're talking about, a simple direction that, at the end of the day, when everything's complete, that there's a simple page that says, the investment in this fund was approved on such and such a date, that contracts have been developed, those contracts are in line with the recommendation of documents or the summary, whatever the motion was, that they've been reviewed by legal counsel. And and therefore
And there's been
they
no-
can be funded.
And there's no change.
And there's no change. They're materially accurate, or
Staff and
materially
I
consistent.
have had some
And
discussions to
signed
that
two
effect
things.
for future upcoming ones. And I've seen some language that seems to be moving towards that end. And I think, I guess these will go to the next one. So,
Yeah, I think when we get a package like that. we
Everybody
get-
look at that when it comes
It's
in.
sitting right on top. There it is. That two cents. I mean, we signed, you know, y'all two right now, the chairman and the CIO sign off basically on something that looks like that. I'm not sure exactly what it does, but if it was correct, you know, on the lines.
It's going to be a little bit more complete. than-
Right. And
Yeah.
it just sits right on top. I think that
Well,
would go along
can
with
we
it.
do-
No, I always have a hesitancy to document everything to death where you get bogged down in having to do things when they're not always necessary. It's a growing process. What I would suggest is, let's see what happens on these. And then if somebody doesn't like the way it's worded, we can say.
But just seems to me the very, almost by definition, having a review period, and then perhaps not having something that is being suggested is so much a contradiction.
I think it's easier on staff. I think it's easier on the investment. Somebody signs off, they send it to us. If anybody has a question, we'll try to open it. I think it's easier on everybody. As a custodian, I have responsibility. I like to go, wow, this is great. Goes that in the file, we're done. Close that, staple it up, never go back. Something goes wrong in your, you better go.
Suzanne, what, in your experience, in other funds, what are they really? Not trying to put you on the spot.
No, it's fair. So most of the groups that we deal with, the board or the investment committee does not deal with contracts. They are given terms when they agree on a investment, and if there's a change in the terms, staff comes back to them. And that is just the understanding they have. There's not necessarily documentation from staff that it is exactly what was presented, but if there's concern about that, I see it as a reasonable measure. Brady, what have you run into? But I don't have any groups that actually review contracts. There may be, trying to think through, I haven't seen it before. Have you run into public ones?
No, I mean, my experience is similar to yours, where the investment is approved, and then the legal department is given the authority to execute. And it would only rise to the board if there was some sort of problem or two.
I think that's pretty much the standard business general. I don't think the chairman of General Motors reviews every contract that goes out of General Motors.
I agree. So what I'm hearing is that since the staff has not come back to us, they're going to go and take the summary memo sheets and go to the file. They're all going to match up 100%. Is that what we hear? I mean,
I didn't hear that, but you may.
well, there's a change coming back. I'm trying to think about it.
Terms may be, Mr. Chairman.
I mean, terms get more favorable.
Well, that would be a wonderful thing to let us know. We'd like to congratulate them. But, it's a lot of liability on whoever's making this verbal decision.
And there's a lot of liability on the person signing the contract.
That's why they're professional.
Well, what are we
Okay.
going to do?
But we've had a discussion, there hasn't been a motion on the floor to do anything.
Well, is there any objection to?
Well, I mean, I think it's along the lines with what Barry said he was gonna do going forward, and we're gonna table these two things, and we could just, I mean, roll this last discussion up into those two or three things, because it's a natural part of it. And let's see if we can wrap up all three things, so when y'all approve an investment, we can be confident that when everything's done, we're all comfortable that everything's been done that needs to be done, and it's ready to go.
And I know a good lawyer like this. He works with free.
Yeah.
Yeah, I think we should come up with a protocol for legal staff. I don't know what investment secretary sign it to, but for the staff to sign to the present to the chairman Chairman, upon requesting his signature.
And I think we should focus on that summary investment chart, because let's face it, those are some of the key terms that everybody's worried about, the fees and stuff. And, making sure that, if there's any changes, those are real, and if they're not negative, then everybody should feel comfortable. That can further reduce this review period. It sounds like everybody would be happy about that as well.
Okay. Next agenda item is the Bone Melon settlement. The settlement was a matter of public record, and the attorneys for the treasurer not we invited them to come and give us a report, and because of various constraints, they can't do it, but the treasurer can give us a report. So I'd like to invite you to give a report on the settlement.
Show you my considerable legal skills. There are constraints. Settlement has been reached in the matter of the state of South Carolina versus BNY Mellon. It is comprehensive, it's equitable, it's beneficial to the state. It allows the parties to settle their differences, shake hands, and work together, and enhance partnership and better safeguard the account. Treasurer's account, which manages the state's assets. State treasurer's account custodies approximately $40.5 billion. It's not just this much money and assets that belong to virtually every political entity of the state, and of course the funds of the state retirement system. The litigation has required the attention of 2 attorney generals, 2 state treasurers, 3 investment commissioners, 2 chief investment officers, and scores of staff and lawyers and consultants and outside experts. I think I can speak for them all by saying it's done finally. It's over with. And I want to publicly thank now many of those that were helpful in supplying the information and the support and the expertise in the effort. The Attorney General's office was efficient and well-staffed and supportive. They hired and managed the legal teams, and perhaps most importantly, they provided true experience, the gray-haired kind of experience that you just can't buy in this complicated legal matter. The AG's participation was ably and thoughtfully done by Attorney General Henry Master, former Attorney General, and then energetically continued by Alan Wilson. I thank them both. They both showed leadership, and their leadership has been positive in terms of this matter. And I'd like to thank the outside legal teams themselves for their diligence and their professionalism. The breadth of knowledge and experience is astounding. For some of the team, it was as much as 3.5 years of very long days, working on weekends and holidays and traveling to both coasts and many places in between. They dealt with some of the most arcane aspects of high finance and interstate law, constantly changing economy and values, and all the time they had to balance the uncertainties of complex litigation and the legal system. Their work is remarkable, and their personal efforts, I believe, are heroic. I thank them for successfully bringing closure to this litigation in a manner that benefits the citizens of South Carolina. I thank the Investment Commission, and people at this table, that had countless hours in sifting through mounds of documents, supplying information and specific financial and legal assistance. As I mentioned before, 3 different chairmen have been supportive and given their time and the time of the staff for briefings and made them available for us to harvest all sorts of knowledge and information. Much of the work fell to the Commission's first employee, Nancy Shealy. Dory Diddy, I'd like to thank her personally for her positive attitude despite the long days in mediation, bumpy airplane rides, and even bumpier and hurried rides across to New York City to make these appointments. We had quite a ride that last flight to New York. The Investment Commission staff has always helped and has never complained about the extra workload and long hours. They were not paid for any of the extra hours. The Investment Commission was not the decision maker in this litigation, but their assistance was positive, was helpful in the state's attempt to recover funds for the South Carolina retirement system. I'd like to thank my predecessor, Treasurer Converse Chellis, for having done the time-consuming due diligence and having built consensus with the various stakeholders. The Treasurer's Office staff has been gracious with their labor and support. Their countless overtime hours were logged without pay as well. There's never a shy word. I mean, we lean on these folks a lot of times. There's never a shy word about the extra work they had. Once again, the Treasurer's Office exceeded my expectation. I'll be forever grateful. And lastly, I'd like to thank the Bank of New York Mellon. South Carolina Investment Commission has a progressive and complicated portfolio that requires a great deal of attention. We simply must have the best possible customer bank. We simply must have the best possible relationship with them. And while we certainly had our differences, and at times those differences were not only intractable, but noisy. The bank, as did the state, made painful accommodations, and those accommodations and those painful decisions made compromise possible. The settlement will allow us to not only maintain our bank-client relationship, but to become true business partners that has each other's long-term interest at heart. Over the last 2 months, the bank has demonstrated the sincerity of its new commitment to South Carolina many times over. As recently as yesterday, I found myself sending a Bank of New York Mellon staffer a thank you note for work well done and completed ahead of schedule. South Carolina needed a partner of this sort. We have found one. We worked many aspects of this relationship over in the last 3 or 4 or 5 months. And I can promise you that the relationship we're going to have forward with Bank of New York Mellon will benefit South Carolina greatly. It always haunts me that in the year 2000, South Carolina was 39th per capita income. In the year 2010, we slipped 46th. We're not a wealthy state. We're creating value. We must create value for the interest and for the people of South Carolina, and that must always be our concern. It's been an honor to work alongside the various groups that allowed this effort to be a success, just as it's an honor to serve as State Treasurer. Mr. Chairman, I appreciate the opportunity to address the Commission today. As a lawyer, you surely appreciate that until all settlement transactions are completed, I can't speak to the details of the settlement, but I can assure you, and I assure that you appreciate the State Treasurer has delivered to the Commission and other stakeholders the settlement documents on the day they were approved by the court without anyone having to request those documents. The State Treasurer's Office recognizes the obligation of its obligation of co-fiduciaries to keep each other informed and to willingly supply information that will promote the legal and trusting relationship. Mr. Treasurer, as always, the state's legal team stands by ready to brief the fiduciaries on the subject, either individually or as a group, and the group will be an executive session. Thank you again, Mr. Chairman, for this opportunity to support the matter and for allowing me to the opportunity to address this. As soon as the final transactions of the settlement are clear, we'll be able to speak about it purely.
But tell us a lot about it. Tell me, as I read the settlement agreements, it says that the Treasurer may respond to questions from and give verbal reports on the matter and its resolution to the Retirement System Investment Committee. So tell us what the settlement is.
I have that information with you. I think you have it there, Mr. Chairman.
No, I don't have it with you, but I have read it. I think you
Well, we
give us a report on it.
All of the transactions have not been completed, and there's a time schedule. And as soon as they're completed, which is not very long from now, we'll be more than happy to talk about it.
What's the dollar amount?
I can tell you. I mean, you got it there, Mr. Treasurer. We gave the documents. Everybody in this room has a copy of the documents. And if you'd like to speak about it, you just go right ahead.
Well, as I read them, it's a $34 million settlement with $9 million of attorney fees. What, did the judge approve the attorney fees? Did somebody approve the attorney fees? How were they calculated?
I didn't approve the attorney fees. The judge did. I had nothing to do with those. The attorneys do not work for the Treasurer's office.
They're represented.
And they don't, Mr. Chairman, you are a lawyer. You know how that works. All lawyers working for the state work for the Attorney General and their compensation, which, by the way, the contract has been on my, employment contract has been on my computer for 2 years. If you'd like to look at it. I'm not going to speak anymore because we do have the final transaction. If you'd like to meet next week, I'll be here. You're more than welcome.
I had just one question
Yes,
related. So, have y'all executed on the RFP? I mean, I know this was kind of a consideration, I mean.
We're in negotiating, man, and we're hoping to move that right along. We've got a couple options, and a portion of this ad is done, it's not done. We hope that next week will be.
One of the things I noticed in there was, there would be a commitment of X billion dollars in the family to their hedge mark fund. What is the hedge mark fund and what's been committed?
Mr. Fritz, I'm not,
That's not specific.
Yeah,
Okay.
but there's not.
Generality.
Yeah.
What's been committed?
Nothing.
Well, it says X billion dollars to be committed to the hedge market. Now, what does that mean? I mean, I don't know. I don't know what the hedge market fund is, first of all.
Well, we have lawyers right there. It's fine, time. I just don't want to prejudice anything that's happened here in the last few days. More than have to come back next week, more than have to talk about it. I'm proud of the settlement. Everybody here has a copy of it. I have not read the settlement since it was done, March 22nd. March the 19th is the last time
The attorney fee agreement I saw was with the treasurer's office, not with the attorney general's office.
Sure.
Are you saying you did not approve these, the attorneys, the $9 million attorneys?
No.
Who did?
Well, listen, I didn't do it. It's, all right, I'm not going to discuss it anymore. Your opportunity here is to try to embarrass me a few days away from closing is for people, because I am embarrassed, because I don't like to be played with. And of course, I knew these questions were coming for days, but I have to sit here and wait. We have, everyone here reached out and gave this agreement. We did the best we knew how. We will be able to speak at it at length next week and look forward to it. And so you can continue to ask me questions on it.
Or will it?
You're an attorney, sir. You're an attorney, you can do it yourself.
The legal staff is going to be meeting with the legal team that handle this matter.
Good. And
they graciously offered to answer all the
right.
questions. What I'd like to do now is have the commissioners tell our legal team the questions they'd like to have answered.
Who can I share?
During that meeting.
I mean, I think it's I think it is FOI-able. Yes, I do.
Not supposed to be public.
Yeah. And I should be making public statements about a settlement until it's transacted. I think
Well,
that's it. And,
I'm just asking
yes,
on behalf of, I'm here on.
yes, sir. And that's why we make sure.
On behalf of a group of trustees of the retirement system, which is part of it, but you said it's not the whole thing.
That's why we make sure. That's why we make sure.
Let me make one
the day we
statement.
like.
Let me make one statement at this point and ask that the records of the commission attach it as an exhibit, Rule 41.1 of the South Carolina Rules of Civil Procedure, which says, and I'm almost quoting now, but it might not be word for word, but it says in part, no settlement agreement with a public body may be confidential, period.
I'm not asking, I'm just saying I'm not going to talk to you, Mr. Williams. I understand your point. Everybody in here wants to. I mean, everyone in this room understands this. Your job here is to try to embarrass me. The facts as they are now will not be materially changed until next week. This is nothing but another attack by you on me. We understand that. So let's please move on. I'm not going to speak about it anymore. Why do the people in this room have to be continually embarrassed by you playing politics? We've said it. I'm not going to speak about it anymore. It's a material, and I believe that my responsibility
I'm going to give
people
each
this day is
commissioner a chance to tell the legal staff what they'd like to find out.
I would like
about
to
the
call,
settlement.
I mean, my understanding on the agenda, if I may, right, is that this is what, for the treasurer's statement on the settlement?
I was never
I mean,
asked
what's
to
our
do this.
agenda say? I mean, what's our agenda item?
This is the last time other than executive.
Right. You know, given the nature of it, you know, I've only seen a brief, I looked at it for maybe 10 seconds yesterday, right? I would prefer to discuss it in executive sessions, right, so that there's not an inadvertent breach, as I understand it. I just think that would be a more prudent course of action.
I looked at that, Alan, and as I read the law, it's not an appropriate matter for executive session. It doesn't fall under any of the exceptions that can be.
Well, unless there's a potential recovery, right? I don't know
Is
how
one
that
is a
works.
legal-
I mean,
is-
it's
The
a-
recovery, that part's over with. So-
It is a legal matter, that it is a legal and contractual matter that we go into all the time. Last week, if you go back, last meeting, you go to the tape, we'll have the tape. You'll see where Mr. Williams asked for an executive session to receive legal advice. Mr. Gillespie said, what type of advice? Legal advice. He said, on what issue? And I think it was Nancy Shealy said, on pending legal problems. They come out, and what do? They have a vote on a different issue. So we go into executive session all the time under these premises. That's why Mr. Powers and I generally vote no. We go under false premises. We have the lawyers and everybody here. You can easily do it. The point of this is to embarrass me. And the quicker we can just let this go on and embarrass me, the quicker we can all go home. I mean, I'm past having you right here. You just told the people who appointed you that they weren't able to serve on the board. I mean, so I understand this. We all understand this. So how do we get out of this? Alan, would you make a motion of some kind?
In order to go into executive session.
Well, we don't have to go into executive session.
There's statutes that govern executive session.
Right, but
And we have to fit within one.
Right, but I think going in to receive both legal advice as well as further detail related to a recovery, right, of a claim, right, is more than sufficient in my mind to warrant going into executive session.
How about my lawyer, who tells me my lawyer all the time, Mr. Feinstein, is there a reason why we couldn't do that? Would you give me a legal reason why we inappropriate or illegal why we couldn't go in to receive legal advice or discuss a contract?
I believe that you are correct, that there was a basis, or at least one basis to go into executive session to obtain advice from legal counsel. If that is the body's desire, I would echo what I heard Mr. Condon saying. We have received indications from both the Attorney General's office and from external litigation counsel, indicating that because of the ongoing nature of some of these contractual matters, that they did advise us to take care with the discussion of this matter in open session.
Thank you. Or two, not two.
To take care.
To take care. I mean, there is a provision that permits, as the chairman said, that permits the treasurer to respond to questions and to give verbal reports to the commission. But because of the nature of these ongoing negotiations, there are constraints on the treasurer.
I agree with Alan. I'd like to hear an answer one way or the other, here or in executive session, and if it means executive session, fine. The reason I raised my first question was X billion dollars
Yes,
amount. Yes, I didn't want to reveal how many dollars we're talking about at this point. And there are other issues like that
Yes,
too, that you have to be careful in how you say.
And let the record reflect that in mere moments, we will be in executive session to receive advice from legal counsel. The problem is you can't embarrass anybody in front of the press in executive session. So what we'd like to do is I would make a motion that we go into executive session.
I'll second.
Great. Do we have a third? I can count on go. Let's
All right,
go.
all right.
Yeah, let's go into it.
Yes,
And I move for a vote.
Hold on, just a minute. I'm ruling as a point of order that since this litigation is concluded, and we do not need, not having been a party to it, do not need to receive legal advice with respect to this litigation. That it is not an appropriate matter to be addressed in the executive session. If we want to receive legal advice on other matters or on investment matters, those are appropriate for executive session, but to just talk about legal things is not an appropriate
Discussion
matter.
of negotiations, incidents, or proposed contractual agreements, number 2 of section 3470.
As I understand, we're not going to be having any discussion about proposed contractual
settlement is-
agreements, because we're not a party
The
to those
settlement's full,
proposals.
the settlement's full of that. As you well know.
The settlement says that you're going to be getting certain rebates based on what you might do in the future. But we, as a commission, are not party to those discussions, so we're not gonna waste time in executive session discussing contracts that we're not.
If you
not
have
entering
decided,
into.
you have decided that 3 people would just ask for that, and the legal definition and the lawyer,
No.
we don't have a say, then fine, we don't have a say, let's move on.
I
Unless we
have,
do-
I have ruled, I have made my point of order. If the commission wants to overrule me and go into executive session to discuss those things notwithstanding that ruling, that's his prerogative.
I'll take
But
that.
I have an
I'll
obligation,
take
I have
that.
an obligation to make sure we follow the state open meetings law. And under the open meetings law, we cannot go into executive session for this matter, period, in my opinion.
It is amazing to me how you think Alan Wilson and Gene Toll just have opinions, but yours is absolute law. I will take my leave here. It is clear that one man's opinion is the only one that matters, and I take this business far too serious. It's $27 billion of retiree money.
If somebody wants to make a motion to.
We made it, you're on the
I'll
right
make a
order.
motion to overrule the point of order.
All right, there it is. Is there a second? I hear no second.
What is this, to go into executive session?
And the point of order is that we cannot discuss this legal settlement in executive session.
And that's your.
Yeah, my motion is to overrule his point of order, so we can discuss
Yeah,
it.
his motion is to overrule my point of order.
There are other matters in executive session. There are.
And then we'll entertain a separate motion.
Yeah, yeah.
Well, like the Supreme Court said, maybe it's a moot issue that nobody here to answer the question.
It'd be inappropriate to speak until the terms have been resolved.
Well, in that case, can we continue on to advise legal staff on what we'd like to know the answers to when they have their briefing from the president? What I'd like to know, and what I think the retirees in the system needs to know, the financial terms of the settlement. Get a full accounting of the dollars that would be paid and to whom, and how allocated, and by whom that decision will be made. A full accounting of what the legal fees are, how they were determined, who approved them, how much of it was cost as opposed to fees, what the applicable hourly rate is, and a full and complete accounting of the legal fees and the determination of them. Because my current understanding is that the legal fees in this particular matter would be at least two, maybe more times higher than would be normally expected in a settlement of this size, when the state is paid the legal fee. And in this case, when this system would be paying a chunk of those legal fees. I would also like to know what ongoing obligations the treasurer would be expecting from this commission out of the terms of this settlement. What we would have to do, if anything, as part of the settlement.
Reynolds, I understand that the monies from this settlement, not all of them, but the appropriate amount of money will go back into the fund.
Well, that's another, I think we want the legal staff to find out how much of that is
But we were not,
retirement system.
but we were not a party to this.
Correct.
So somebody externally will decide how much money is gonna come back to the fund.
Right, and I'd like to know who and how that decision.
Well, I think
is
that's,
gonna be made.
yeah, I think you should know that.
I mean, we got,
Well,
yeah.
as I understand it, there's some discount involved in the future custodial fees as soon as this contract made. Is that correct or not?
We'd like to get that confirmed and clarified.
Right, and who does that benefit? Does that benefit the investment commission or does that benefit the state?
We'd like to get that clarified.
I agree, that's part of what we need to know. Anything else? The lawyers involved in litigation have graciously invited not just the legal team to receive that briefing, but if any commissioners want to be involved in receiving that information in that briefing, they've invited them to attend. I don't know whether any of your staffs are invited to attend or not. At least we are. And I did.
My staff's gonna be busy that day.
My staff will sign an NDA and show up. Anything else, that y'all, with any other guidance we want to give the legal team on this matter?
I mean, maybe, I need to spend more time with the document before I'm prepared with questions, but.
Well, please follow up, feel free to follow up. And we have not yet set a meeting time up. We will try to begin that process after this meeting, and we'll alert you all as to the.
Yeah, well, let's make this be an open-ended solicitation from the legal team to the commissioner.
Right. And have the commissioners, and I apologize because I, might have missed it, the full document was sent in an email. I know a partial document was sent in an email.
No, the full document was sent.
The full document was sent in an email.
Well, I know I got it.
It was posted.
It's
You'll be able to
on
find.
the secure.
It's posted, I'm sorry,
Yeah,
posted as a
posted,
secure
not
post.
sent.
Right.
Yeah, there was a letter that the council sent us that was
Right, okay.
initially incomplete.
Right.
Chairman?
Yes.
I think it would be important to understand that with respect to the settlement or even RFP and where all that is, in this as well, is any services or investment type mandates, if anything that goes beyond pure custody, sole custody as for the trust, to understand what those are and what those costs are. I think that ties back into some of the other questions as well.
Yeah, that ties back into Dr. Pritchard's question.
Jeff, the one question, the money that comes back into the fund, is that, are those funds encumbered in any way, or they just go back into the fund to be invested as any other money?
That's the way they would just come back.
Yeah.
That would be my assumption, is that we go back into the trust.
Well, we'll nail that down. We'll try to be very precise and make sure we understand exactly, how that's going to.
Okay. Anything else? Does somebody want to make a motion to go into Article 9, item 9? That would be to receive legal advice and discuss investment matters. Is there a second? All in favor, signify by saying aye. Aye. Ayes have it.